Let me they can see your screen.
Please, can you all see my screen now?
Yes, we cannot see the screen. So try sharing and see if we can see the other
Can
side.
you see this one, the outline now?
No, only the topic that we can see. So if you try share again, let's see. Yeah, we can see the outline now. Yes.
Okay. Then I think we can work.
Now it's rolling now, so we can see them. Yeah.
Okay, then let me quickly go over the outline once again, and then
Yes.
we'll proceed to the program for the day. Okay, so we'll look at the historical overview of pensions in Ghana. We'll look at the three-tier pension scheme. That is the new Pension Act that was established in January 2020. Then we'll look at the benefits of the three-tier pension scheme, why we even have this pension scheme in the first place. We'll look at tier 1, tier 2, tier 3. That's a breakdown of the three-tier pension scheme. Then we'll look at the enrollment process and the service deliverables that you should expect from corporate trustees, that's SNIT, and the private corporate trustees that handle the pension schemes. Then we'll also look at qualifying conditions for withdrawal, that is, under which conditions can you make withdrawals on your pension portfolio. Following from that, we'll look at TPFA, that is temporary pension fund account, which I'll explain in details as we go along, and then the amendment, which we call the Act 8A3. We also look at the new investment guidelines. We've had several investment guidelines over the years, but a new one was instituted last year, September, which we'll discuss that one as well. And then we'll end with retirement planning. So with your permission, I'd like to quickly move to the historical overview. I hope you can all see the slide now.
Yes, please, we can see it, yes.
Okay, thank you. All right, so as I said earlier, pension administration and contributions and retirement catering for retirees started even before independence. And that was in 1950 when the colonial masters introduced the pension ordinance for workers, mostly public sector workers. This was supposed to give them some monies every month during pension or when they go on retirement. But this was solely for public sector workers. Now, and this is what we call the Cap 30. Currently, a lot of workers have been moved from Cap 30, but we still have the security services and some part of the judicial services with the Cap 30. And that is the pension ordinance number 42. Now, in 1965, government looked at this budget and the fiscal space in the economy. They noticed that paying retirees was becoming a huge part of government budgets. So government decided to set up the Social Security Act 1965, that's the Act 279. And this was supposed to take care of both university workers, public sector workers and all that, but they will start contributing to their pension. So people started paying something to earn their pension when they go on retirement. Now, somewhere in 1972, again, government did another revision or reform. And that was the Social Security Decree. And this one was supposed to repeal the SNIT one and set up a Social Security Fund for Ghana. So this one went beyond just public sector and other, or private people were all allowed to join. However, SNIT as an entity was also set up to take care of this. So SNIT started full operation in 1972 to do this administration and all this pension management thing. Now, they did this for quite some time, up until 1991 when we decided to change this entirely. So back from 1972 to date to 1991, even though contributions were done, government didn't put any financial backing or guarantee to the pension money. So you find out that if let's say something had happened to SNIT or anything, government was not fully committed to that. In 1991, this had to change. So government is to change the thing from the Provident Fund thing, which was the Act 279, to a defined benefit scheme. And by this, we mean that whatever benefits that will come to you is already calculated based on some formula that I will discuss with you as we move ahead. So then SNIT started instituting this. When you go on pension, we'll give you a lump sum, and then every month they will give you a lump sum is a bulk amount that they give to you. And then every month SNIT pays you a monthly stipend. Now this one again from 1991 up to 2007, there were a lot of issues with SNIT's administration of pension funds, the amount that people receive, because people complained that the amounts were too small, and because of that, the trade union and other unions were argued that we want a break. We want private people to be introduced into pension so that SNIT can take care of one part and the other side will be given to other people. so that when we go on pension, if SNIT has done any investment in the economy, we can as well get monies from other things. And remember that the SNIT tier 1 is a defined benefit. And so that one, the money that they'll give you is based on a formula that SNIT created on its own. And so based on how many years you've contributed and the amount you put in and all that, and looking at the current treasury bill rate and all that, they will calculate something and give it to you. As a lot of us do not even know what goes in the calculation, even though the formula is out there. But as and when we get our money, so we hear people talking about the money being too small. So government in 2008 sat down and came out with the National Pensions Act. And this is what we call the New Pensions Act, Act 766. This is what will govern the discussions that we'll be having today. And so I want us all to focus clearly. If you have any questions, you can, I don't know, I'll have to break at a particular time so that you can ask questions. So I'll try to cover a bit. I'll give room for you to ask questions and then we can proceed. So for the New Pension Act started 2008, but this institution or implementation started January 1st, 2010. January 1st, 2010. And that's what we've been using throughout for the past 12 years. Now, looking at the 3-tier pension scheme, as I mentioned, it's governed by what we call the National Pensions Act. I hope you can all see this slide. 3-tier pension scheme. Hello? Hello?
Yeah,
Go ahead,
you can see. Yes.
You can see. All right, thank you. All right, so the New Pension Act 2008 came out with a lot of changes to the way pensions are run in the economy. The first thing that they did was to establish a regulator who we call the National Pensions Regulatory Authority. This is supposed to be the authority that will regulate pension affairs in Ghana. Now, even SNIT was put under NPRA. So now, formerly we had SNIT being the mother of pensions and still are the mother of pensions. But currently, SNIT is under NPRA. So SNIT submits their report to NPRA. Now, apart from SNIT, which after breaking the pension into 3 tiers, that's tier 1, tier 2, tier 3. The tier 1 is what we gave to SNIT. Tier 1, we gave to SNIT. Now we have tier 2 and tier 3, which are managed by private corporate trustees. I will explain as we move ahead. Now, this corporate trustees that were brought on board, they were supposed to be licensed and approved by the NPRA. And so just like for the banks, we all know that commercial banks in Ghana, there's a Bank of Ghana that supervises their activities and all that. For pensions, it is the National Pensions Regulatory Authority. Now, in addition to creating corporate trustees or licensing corporate, that's private entities that will manage pension contributions, they were allowed to also choose a fund manager and a custodian. So the service providers in the management of tier 2 and tier 3 pension were now 3. If you add NPRA, it becomes 4. And so the corporate trustees are the private companies that take your contributions, do your evaluation of your scheme, give you statements. If you have any queries, they're the ones you go to. Now, these corporate trustees cannot do the work of pension alone. And because of the issues government had with SNIT, government had to break these ties. So government said, okay, for corporate trustees, you cannot touch the money. So that means that corporate trustees were by law required to appoint a custodian bank. And this bank is supposed to be a commercial bank licensed by the Bank of Ghana and the NPRA. So the custodian banks are the ones that receive the contributions, that is, monies that people are paying towards their pension. Now, the custodian bank too cannot take any money from that account until they get instruction from the corporate trustee, and vice versa. The corporate trustee too cannot make any claim on the account unless it's for payment of benefit or audit fees or any other thing apart from, but you cannot write any check on the account except for these 2 things or 3 things. Now, for fund managers, they were also brought on board. Fund managers are financial institutions that mostly do fund administration, fund management. So like the data banks and the IC asset managers, Sem Capital, InvestCorp, there are a host of them in the industry. they are supposed to be doing investment on your behalf. But what happens is that they cannot even do the investments on their own. So what happens is that they go to the market, look for the investment that is available. They write to the corporate trustee. They send what we call the investment advice. Then the corporate trustee will then look at it with their team in-house, check if this investment is good to go. If it is good, then the corporate trustee will then instruct the custodian bank to make the payment. So at no point will any of these three people have access to the money. The work of each other depends on the other to facilitate the transaction. Now, just as I mentioned, SNIT is in charge of Tier 1. Tier 2 and Tier 3 is managed by corporate trustees who appoint fund managers and custodian banks. Now, again, in the Act 766, government mentioned that, or it was stated that contributions up to 35% is tax exempt. That means that for all of us, or each employee in Ghana, you have up to 35% of your income, that's your monthly income, tax exempt. That means you won't pay tax on it. But this is shared among the 3-tier pension schemes. The first one is what we call Tier 1, which I said earlier that is managed by SNIT. And this, your employer, which I believe will be Ghana Health Service or Ministry of Health, pays 13% on your behalf, and that is government or Ministry of Health, paying 13% of your monthly salary into a Tier 1 with SNIT. Now, this is the amount they are paid, that's 13%. For Tier 2, they deduct from your account 5.5%. 5.5%. But if you check the slide, you see that I've written 5% for Tier 2 and 13.5% for Tier 1. Reason being that after your employer deducts the 5.5% from your pay slip or your monthly income, they add the 0.5 of the 5% to the 13% that your employer will pay. And they will send the 13.5 to SNIT. That's why you see 13.5 there. Now, for those whose salaries are not more than their salaries are not more than the minimum wage. Government or the law states that they should use the minimum wage to calculate that pension on your behalf. They should use the minimum wage to calculate on your behalf. Now, Tier 3, which is supposed to be voluntary. Tier 1 and Tier 2 is mandatory. No worker is exempted from this. That means that when you are working, both in the formal sector or informal, it is advised that your employer pays 13% on your behalf. You pay 5.5%, out of which 13.5 is given to SNIT, and then 5% is paid to a corporate trustee. These two are mandatory, which makes up 18.5%. Now, the Tier 3 is the voluntary one, and thus I'll explain as we move on. And that one, you can do a total of 16.5. Again, there's an addition to the SNIT one. If you are working with Ghana Health Service or Ministry of Health and your salary is above 35,000, what SNIT is saying is that they can only take 13.5% of 35,000. Any extra money that you are making, you should send that 5% of it in addition to your Tier 2 to the corporate trustee as Tier 2, which we call excess of Tier 1. Now, the 16.5 of Tier 3 is voluntary. And so just like I mentioned to you earlier, 35% is what is tax exempt. So if you want to enjoy the full tax under the income tax law or the pension law, you have to do 16.5% in addition to the 18.5 that you already contributed to SNIT and the corporate trustee. And as I earlier indicated, both the retirement benefits and the investment income and everything that comes to you is tax exempt. So for Tier 1 and Tier 2 and Tier 3, everything is tax exempt. Now, the next slide gives us just a pictorial view of what I just described some few minutes ago. Now, this graph just shows you how the pension industry is structured now, the new pension administration. So we have the MPI, which is the green that I've indicated here. Then we have the trust board. The trust board is supposed to be the one on the board of the corporate trustee who supervises what the corporate trustee also does. Then we have the corporate trustee, which is the private institution that takes your pension, gives you statements and all that. And they appoint the fund manager and the custodian, which I clearly indicated before. Now, the next slide gives us some benefits of the three-tier pension scheme. And so quickly, I'll run you through it. Before the Act 766, the old pension law was requiring contributors or workers to contribute up to 20 years before they can enjoy full pension. And by full pension, we mean at age 60, when you go on retirement, then SNIT will calculate everything and pay you full pension. Now, this brought a lot of controversy among labor union and workers. And so we ended up, when they were doing the Act 766, they changed it to 15 years, which is supposed to be the minimum years that a worker is supposed to contribute to benefit from a full pension from SNIT. For tier 2 and tier 3, again, when we get there, I'll explain it in details. That one, it doesn't matter the number of years, because whatever you contribute is plus the interest is what you get. Now, again, the new three-tier pension scheme added what we call porting of accrued benefits or transfer of accrued benefits. Now, many of you might have worked somewhere before you joined Ghana Health Service or Ministry of Health. Probably were doing one or two things before you joined them. Now, wherever you worked before, I believe you contributed to a pension scheme, which will either be a tier 2 or a tier 3. Now, the new law allows you to do transfer of contributions from your old trustee to a new trustee. So if the new trustee for Ghana Health Services may be Enterprise or Pensions Alliance Trust, you transfer from your old trustee, which could be another trustee, to this new trustee. And that's what we call porting of accrued benefits. There have been times where people die, and because they fail to transfer their accrued benefits, their family is not able to identify or know exactly where their corporate trustee, which corporate trustees they contributed to, and where they can access their full pension. And so we always advise that when you move from one employer to another, reach out to your new trustee and transfer every single amount that you have on your account to your new trustee, so that at the time that you go on retirement, or God forbid, if you pass on, your beneficiaries, which I'll discuss to you, beneficiaries are supposed to be people that you assign on your form, that in case you are no more, we should pay the monies to. Now, these people will be able to get the full money that you contributed to. However, if you fail to do this, that means they can only assess a part of these benefits, of accrued benefits. Now, the third thing I would like to touch on is what we call improved lump sum payments. By improved lump sum, we mean that when SNIT was in charge of paying both lump sum and monthly stipend of pensioners, people were complaining that sometimes a driver who has worked for 35 years, who was expecting that he will get some huge money, about 100,000 or 80,000 to buy a car to continue his transport business, gets shocked when SNIT gives that person 10,000 Ghana cedi for working 35 years. Now, what the new Pension Act is trying to do is that the tier 2 and tier 3 do not go by any formula. They work on what we call the compound interest. And so the monies that you pay monthly, the interest that comes on it, that is, I'll show you again after when we get to the latter part of the slide. The investments that are done in the portfolio, every interest that is used on it is paid to you. There's nothing hidden about the tier 2 and tier 3 investment and calculation of returns. Everything is investments. We can all sit down and calculate together and know the returns that is due and give it to you. So that is another benefit of the three-tier pension scheme. We also have what we call using your benefits to acquire mortgage. Now, in the new Pension Act, the law allows tier 2 and tier 3 contributors to use their contributions to secure a mortgage, and this is mortgage for a primary residence. Mortgage is a contractual agreement with a financial institution for a building or for an apartment or anything, which you pay in monthly installments. And so this is what the law allows. It is not that when you are building a house somewhere, then you write to your trustee that I am building a house, so give me money. No, that one, we all know how the system is and how people can take their pension and chop. Because remember that Social Security, even though government is giving you tier 1, we are aware that that money is not so much. And so government needs to secure the retirement of every employee. If it is left for employees to withdraw their money, trust me, I don't think some of us will even have 10 cedi when we get on retirement. And so that's the main reason why government is saying that this money must be kept. And the only time that you can have access to this money is when you are taking it to get a mortgage, or the conditions that I'll share with you as we move on. We also have this tier 3 also brought on board the informal sector. Now, before 2008, the barbers and mokola workers and apostle those spare parts dealers and all that, they didn't have any pension. And so most of them go to pension, rely on their children. Now, this one introduced another aspect of the pension where those in the informal sector can also contribute towards pension. And so these 5 are the key benefits that I've talked about. There are a lot more in the law. Now, I'd like to take you through the tier 1, tier 2, tier 3, how it's done, the way it is, and the various details of it. So that when I end that, then I'll open for questions, and then we'll continue from there. So the next thing I'll touch on is tier 1, just tier 1. What is tier 1 about? Now, as I indicated earlier, tier 1 is managed by SNIT. That's the Social Security National Insurance Trust. And this is mandatory, like I mentioned. Every worker in Ghana is supposed to get or be contributing to a tier 1. But this is paid by your employer, And so we have 13.5% of monthly salary, or the national daily minimum, like I stated earlier. Now, this is a defined benefit scheme. And so if at no point can SNIT tell you, say, we don't have money to pay retirees, it is something that is, yes, hello?
Can you show the full slide? Someone's asking if you can show the full slide in full slide mode also. I guess it's better now. Okay. Okay.
Can you see it now?
You can see it, but I don't know. Yeah, it's better now. It's far better. Yes.
It's better. Okay.
Okay.
All right. So as I was saying, that SNIT tier 1 is compulsory. It is managed by SNIT and is contributed by your employer. So it's your employer that pays. Any employer that fails to pay the contribution, the law deals with them. Now for SNIT set up a prosecutorial court that takes employers who do not pay contributions on behalf of their workers too. And so we have that your contribution is supposed to be sent to the corporate trustee or to SNIT by the 14th of the following month. Now, as controller or Ministry of Finance is paying your salary, what the pension law requires is that at the end of the month, when payroll is putting together the salary, payroll is supposed to send a schedule, what we call a contribution schedule, which contains the list of all employees, their SNIT numbers, or now the Ghana card, the amount, their basic salary, and then the 5% that they are contributing. But in this case, it is a 13%. So they send the 30% to SNIT. So SNIT has a portal that employers or payroll officers upload onto. Now, if they don't pay this, the law states that the employer will be charged a penalty of 3% per month on the contributions that they fail to pay. So assuming that for this year, no contributions has been paid to SNIT on your behalf, the Ministry of Health or Ghana Health Service can tax whichever agency is supposed to pay, which yours is government. So I doubt how you can get a penalty though. But for the sake of education and for what is actually happens in the industry, for private institutions, they are taxed to pay 3%, which makes up to 36% a year on the contributions that they pay. So those employers that do not pay, the law has a way of taxing them to pay the monies plus penalty to contributors. Now, for SNIT, in the new pension law, the only thing that SNIT will do for you when you get to retirement is to pay out a monthly stipend. That's all. So every month they give you something. This is computed in a way that I'll show you in my next slide. So what we call the computations of pension rights. Now, every employee in Ghana has a pension right, such as those who contribute. For those who do not contribute, the law says contribute to informal or personal pension. For those security service people who do not contribute anything, they are given a cap 30. If you don't fall in any of these categories, then I'm sorry, you cannot get pension money or retirement money when you go on pension. Now, again, as I indicated earlier, the minimum number of years to give you pension, full pension, is 15 years. That is 180 months. Now, this guarantees you 35% of your salary, 35% of the average of your annual salary for the 3 best years. So what SNIT does is that they take the best 3 years of your working life, your income, and then they strike an average. Out of this average, they pay you that 35% of this annual amount is divided into 12, and that is what is paid to you. So if we are trying to use, let's say, if we earn 1,000 cedi a month, now, the likelihood that if you have contributed to 15 years, SNIT will give you just 350 is very high. So for those who earn about 1,000 cedi, the maximum you can get if you've worked or contributed 15 years to SNIT is 350 Ghana. If you earn 2,000 cedi now, the maximum you can get from SNIT monthly is 700 Ghana cedi. Now, there's a second layer to this. Now, if you work beyond the 15 years, every single year that you work earns you an extra point of 1.125% for every year. So if you work for 25 years, you get a 35% plus 10 years times the 1.125%. So that will give you something around 11.25%. And this, when you add to this, will give me about 45.125. Okay. And the next point tells us that the maximum that you can get from SNIT is 60% of your monthly salary now. So if you are earning 1,000 cedi now, the maximum you can get, that is if you work like, let's say, 35 years, contributed 35 years to SNIT, the maximum you can get is 600 Ghana cedi. If your salary is 2,000 now, the maximum you can get from SNIT is 1,200 a month. If your money is 3,000, the maximum you can get is about 1,800 a month. And you and I know that even those who are earning 1,200 now in this current Ghana are struggling. So if you want to earn that money in the next 20 years, obviously it will be very difficult for you. Okay, so let me quickly move to tier 2 as well. For tier 2, like I mentioned earlier, that's what we call the occupational pension scheme. Now, this scheme is designed for entry by your employer. So this one is your employer who leads the discussion to get a trustee that will manage your affairs. So for Ghana Health Service or Ministry of Health, it is the Ghana Health Service or the Ministry who goes to look for a corporate trustee to, on your behalf, to pay your tier 2 contributions to. Now, this tier 2, as I mentioned again, is mandatory, but this is a defined contribution scheme. The first one, tier 1, I said, is defined benefits. That means that your benefit is decided for you. But this is defined contribution scheme. That means the money you get during pension is as a result of how much you put in and for what period you put in and the interest that was available on the market. That's the bond rate, the government bond rate, the treasury rate, and all that contribute to give you what you take home. Now, the deductions, as I mentioned earlier, is 5.5%. So when you check your salary, your payslip, you should all see a deduction of 5.5% towards your tier 2. 5.5% towards your tier 2. But when you check your tier 2 statements, you notice that the amount that is on your tier 2 statement is just 5%. 5%. That's what I said earlier, that 0.5 of the 5% is added to the employer's 13.5 and paid to SNIT. So when you check your SNIT contribution, that money is 13.5. But when you check the one that you've paid to a corporate trustee or your tier 2 scheme, that one is 5%. When you add these two, it gives you 18.5%. Now, again, when you check your statement, there's one key thing that you need to focus on, and that is the date of payment, or the date, what we call the receipt date. That's the date that your monies hit the account of the corporate trustee or the custodian bank. And that is supposed to be before or on the 14th of the following month. So let's say we are in August now. Today is August 13th. So latest by tomorrow, which is Sunday, 14th of August, July contributions is supposed to have been paid. So if any money is supposed to be paid on your bill, that means it was supposed to be paid on Friday, that was 12th, because we all know that Sunday banks don't work. And so if they even send check to the bank, it will clear next week, which is a breach of the law. And so if you are supposed to send check on behalf of your employees, you're supposed to send it probably on the 10th, so that by 13th or 14th, it has cleared. Now for the tier 2, the penalty is even more stringent and very is higher, way higher than what the SNIT even charges. For tier 2, the law states that if an employer fails to pay the contributions by the 14th, the corporate trustee together with employer should charge 3% per month penalty compounded. So that means that for a year, when we compound the 36%, it could be like 48%. And it goes on and on till you finish paying the money. So if maybe you have a company that people are working for you and you are not paying their tier 2, and one of your workers take you to MPRA, what will happen is that if you've not paid their tier 2 contribution since 2014, 2015, the law requires that they will compute every single thing month on month and calculate the penalty 3% compounded, which I believe with the amount you are owing is 10,000. After compounding, it could be 500,000, and that will be very difficult for you to pay. Now, with regards to lump sum benefits, now the law says that tier 2 is supposed to cater for your lump sum. So that one started in 2020. That's 2 years back. So SNIT, after the new law, paid both the lump sum and the monthly contribution up to 2020, where they stopped. So all those who retired 1st January 2020, SNIT only pays them their monthly pension, and then their corporate trustee will pay them their lump sum. So now for us that are still working, it is the tier 2 company that will pay your lump sum money. And this is based on the 5% that you've contributed, your income level, how much comes to us, and the investments that are done on your behalf. The next one is investment income and retirement benefits. And this one is similar to the tier 1. Every investment that is done on your behalf in the tier 2 is tax exempt. No taxes apply to it. And then when you are paid your retirement benefits too, there are no tax. Now, the next thing I'd like to touch on is the tier 3, which is the wonder game, or the one that changes the entire thing. As I mentioned to you earlier, the law allows you to do 35% tax-free. Most of us are only doing 18.5, which if we even look at it, like I explained to you, what the SNIT will pay you and what it is likely that that money will not be enough for you during retirement. And so what the law is saying is that each of us can contribute voluntarily to what we call a tier 3 scheme. Some of you know it as Provident Fund, and some also know it as tier 3. It is the same. This is supposed to be voluntary. If you like, you join. If you like, you don't join. And this you can do up to 16.5% of your monthly income, or the national daily minimum wage, which one is higher. So if your money, if you are paying someone at your shop for 200 cedi, if you want to contribute tier 2 on behalf of that person, you don't use the 200 cedi. You use the minimum wage, which is around 365 cedi or so. That's what you use to compute and pay to SNIT and to the corporate trustee. Now, this tier 3 or provident fund can be done by either the employee or the employer, or both. You see that the tier 1, I told you that, or I mentioned that is tier 1 is done by employer, tier 2 is done by employee. But for tier 3, it can either be done by employer or employee, or both. Now, this tier 3 is also supposed to pay lump sum benefits to retirees, lump sum benefits to retirees. So when you go on retirement, you can access both your tier 2 and tier 3. Now, if you don't want to take your money as a bulk, you can always work it with your corporate trustee to get an annuity, which will stagger the payments that will be made to your account. Or you can have a separate discussion with the trustee that if I'm earning, let's say, 10,000 cedis as interest on my money, you can say that, okay, pay me 6,000 out of this 10,000 interest that I get on my money, and then let the principal still keep running. That is what most people don't know. So once they're going on retirement and they see 50,000, they don't even care how much they are earning every month. They just move for it and go for it. They'll be like, give me my, I'm due, so just pay my money and let me go. Now for the tier 3, the law is stating that you do not need to wait for retirement before you can access your tier 3, even though the law advises that that is the most ideal. But if you have any need of money, you can always access your provident fund or your tier 3 thing. But if you've not done contributions up to 10 years, that is from your first contribution date, 10 years, you will pay a 15% withholding tax. That is by law, because note that I mentioned that the contributions to pension are tax exempt. So before government will take income tax from your payslip, government first deducts, or your payroll first deducts the pension contribution before they tax you. That means that the pension contributions that are paid on your behalf, there's a part of government money in it. And government is giving that money to you after 10 years. So if you want to take your provident fund before 10 years, government says that give me back my 15% as withholding tax. There's also another part of it, which we call vesting rules. Now, Ghana Health Service may have a tier 3 or a provident fund that workers contribute to. And they have rules and regulations they call vesting rule that applies. For some institutions, they can say, oh, if you work for 5 years, whatever the employer has contributed for you, you can take it. That means if you join Ghana Health Service or Ghana Laboratories workers and you don't meet the minimum 5 years, if you leave, whatever has been contributed on your behalf, you will leave it for the employer. But if the employer is let's say the employer falls up or the company collapses, that one, every money that has been paid comes to you. Now, there was also another discussion on whether you can pledge your tier 2 or tier 3 for a loan or something that you're going to take. Now, even for SNIT, the mistake that most people do is that when they take student loan from SNIT and they finish school and they don't get work, some of them, even when they find work, they find it difficult to pay their monies that they owe to SNIT. At the point, SNIT starts deducting that money from their monthly contributions. Now, it looks like it will initially to look like it's something that is favorable for you because you don't feel it so much. But what you suffer with is the 15 years contribution that I mentioned to you earlier. That if you allow SNIT to take the monies from your monthly contribution, what it means is that you may have worked for 25 years, but if you use 15 years of that 25 years to pay your student loan, SNIT will consider that money as not part of your monthly contributions. So even though you worked for 25 years, in the books of SNIT, you only contributed towards your tier 1 for 10 years. And that means that SNIT will calculate your pension using 10 years, which do not give you full pension. That is a bit of information I wish to give to you. Again, so that is it. For those who have tier 2, if you have tier 2 account, nobody can link your tier 2 to any loan that you're going to take. So if you're working somewhere that someone, association or anything is trying to take money to use your fund or something for that, it cannot be done. The only thing that can be used to take a loan is the tier 3, that's the provident fund. But the tier 2 is for retirement. So that one, nobody, not even a bank, not even government, nobody can touch that money. It is the tier 3 that can be used to do that. But not that if the association wants to take any loan that is given to an employee, then they have to first pay that 15% withholding tax, and they can only get 85% of the money to service the debt. On that note, I'd like to end here. If there are any questions, we can take them now, and then we'll continue with the remaining slides. Thank you.
Thank you so much, Mr. Baxton, for this important topic that you really discussed with us. We learned so much from you concerning, which includes the history of the pension scheme in Ghana, the tier 1 to 3. Thank you so much. And also the different acts which governs pension schemes in Ghana. Participants, please, your questions are welcome. If you want to ask a question, you can raise your hands or you can put in the chat box there. Okay. I think we have a hand raised from Mr. Amwa. Okay, there's a question here, the chat room. Please, can you go through how SNIT monthly calculation is done with when you go on retirement?
Okay, so can I take it now?
Yes,
I should wait for all the questions.
No, you can take it as you go ahead. You can take it,
yeah. Okay, then let me take it now. Okay, so for SNIT is tier 1. And like I mentioned, SNIT is a defined benefit scheme. The first thing that they use is what we call the best 3 years salary. That's the annual. They take your annual salaries, the best. So let's say currently your annual salary is around 30,000. Maybe when you get to 55 years, annual salary is 200,000 or 300,000. For the year, when you are 58 years, 59, 60, assuming you retire, you end with the best salaries during these last 3 years, which most people do. They take this 3 years, the best of them, they divide it by 3. So they divide that one 3. But out of these 3, what you get is they also consider the minimum number of years that you need to contribute. That I mentioned that it is 15 years. That is 180 months. So they look at that. If you've done 15 years, that means you are guaranteed to get 35% of whatever monies you contributed at the prevailing treasury bill rate. So that's what they use to compute that for you. Now, if you've done more than 15 years, every single year that come on, they add 1.125% for each year. That's what we have here. 1.125% each year. So if you've done, let's say, 25 years, the first 15 years gives you 35% automatic. So that's 35% of your average salary that they will give you. If you've done 25 years, that's those who started working at age, let's say 35, they have 25 years of working life. So they will get 10 years times 1.12, and that will give you about 11.25%. This 11.25, when you add to 35, it gives you 46% or 46.2. So whatever you get from SNID, the monthly money will be around 47% of what you used to earn before you went to retirement, and it continues on and on. But note that the maximum you can get from SNID is 60%. Again, for those who fail to contribute the 15 years, that probably have done 10 years. What happens is that SNID will compute will take your total contributions that you've given to them. If maybe you've done 14 years and 11 months, it's not 15 years. So SNID will take all the money you've contributed to them, take the prevailing treasury bill rate. If we take let's say the 1 year treasury bill rate now is around 26%. So if you take that one, we'll multiply it by 75%. So they'll take 75% of 26% and multiply it by the total amount that you've contributed. So if you've contributed 10,000, they multiply the 75% of the 26% to the 10,000, and that is what they will give to you as your pension money. So that one, SNID doesn't do any monthly thing with you. It will pay you a lump sum, and it's done with you. Now, again, SNID, there's a minimum age that you can start SNID contribution, and the minimum is 15 years. The maximum is 45. So assuming you've stayed in another country, or you've been in Ghana but you've never contributed to pension, you've been working and you join Ghana Health Service probably at age 46. What the law states is that you cannot contribute to SNID, because even if you start at 46, there's no way you can do the minimum 15 years. So SNID says that don't even pay monies to us at all. Send that money to the corporate trustee, and the corporate trustee will do their investments with your money. So when you go on retirement, they will pay you your lump sum. And that is way better than using whatever you have times the treasury 75% of the prevailing treasury bill rate to pay you your benefits. I hope it's clear. Thank you.
Okay, thank you. The question here is with tier 3, what percentage can you withdraw from it before 10 years?
Okay, so tier 3, just like I mentioned, is about vesting rules. Vesting rules. As for the law doesn't give any percentage that you can withdraw. The law have left it to the employer or the association or whichever group that you are under. You all have to agree on a particular rule or percentage that you want to work with, because the main idea is not to buy television or to rent a house. The idea is to have the tier 3 as an addition to the pension money that I described to you, that it wouldn't be enough. In the latter part of the presentation, I'll show you how the tier 3 works, and you see the magic of compound interest, how it can quickly get you to what you need for retirement. If you treat tier 3 as another savings account, what will happen is that during retirement, after they give you tier 1, which you will not be happy with, and you come for a lump sum from tier 2, which is that 5% of your basic salary, you will not be happy with what you get, and that is what will make you die faster. Because when you go on retirement and health complications and all those things are there, you will now be kind of miserable, because at that point, you have a lot of bills, but yet your income is small. And so we advise that it is not about the percentage, because the law allows you to take any amount you want, but it's about the vesting rules around the scheme or for the group that you belong to. So assuming that Ghana Health Service have a welfare scheme and it's managed by a tier 3 company, and they are saying that, okay, because of want you to have money for a future date, when you work for 5 years, we can allow you to access 30% of that money. When you work for, let's say, 10 years, you can also access another 30%. And so it is a way of giving some money back to members, but as well making sure they have enough during retirement. And so there is no percentage in regards to withdrawal. Thank you.
All right, thank you. Let's take a question from Mr. Amwa, then we come to the chat room. So, Mr. Amwa, kindly unmute and ask your question.
Hello, sir.
Please kindly go ahead.
Yes, please, about the tier 3. I want to find out whether the fund managers are internally from the facility or has to be an established fund manager that is known by the government. And my second question is, what is the percentage in the tier 3? Will the employer and the employee contribute to the 16.5%?
Okay,
thank you.
Okay, let me start. Okay, thank you. Okay, so like I mentioned, the tier 3 is voluntary, and but it's regulated by law. If you contribute it to a corporate trustee that is licensed and validated by law, then the law covers you, because if there's any issue with regards to your money or the management of your funds, then you can take your concerns to National Pensions Regulatory Authority and they'll help you with it. But what happens is that sometimes people do it in-house, or some institutions or associations do it in-house, where they have their own system in-house, they give their monies to a fund manager, and that is done. Now, assuming that your fund manager was part of the fund managers that lost their license in 2019, what happens is that whatever monies you put in is gone, because you didn't have any cover with regards to the law. This is what we call it non-compliant schemes. That means whatever you are running in-house is not recognized by the law. It is just something that you are doing in-house. And so what we advise is that even though you are collecting the money in-house, you are supposed to get a corporate trustee that has a fund manager and a custodian bank that works it. So the corporate trustee will not even touch your money. You only will be given an account details where you pay to, and you are part of a broader fund or a bigger fund where your monies are invested by a very skilled fund manager who is also licensed and approved by the Securities and Exchange Commission. And you have also a bank in there who is regulated by the Bank of Ghana. So it looks like we have 3 people who are regulated by separate regulatory bodies, and they are working together for the safety of your money. So for tier 3 and tier 2, there's a lot more security layer to the business that is done. And if probably even the corporate trustee goes down or loses his license, your monies will not be lost, because every month reports are sent to the regulator. Both the corporate trustee, fund managers, and custodians all send reports to the regulator. So your records are there. But if you do it in-house and your records are only with your HR and payroll, that one, when someone squanders your money, or when the company that you invested with goes down, your money is gone. Now, with your second question, which has to do with how much of the employer and employee, just like I stated, it is a total of 16.5%. So if the employer is doing 5%, you can do maximum 10% in addition. You cannot do both of you is the 16.5%. Both what employers and what you are doing should be a maximum of 16.5%. Thank you.
Let's come to the chat room again. Yeah, hello. It says,
Yeah.
What is the minimum redemption period if you want your cash before or after 10 years in respect to tier 3?
Please, like I mentioned, it's like the previous one. There's no minimum redemption, but it's based on vesting rules. Okay. You see, the tier 3 says that nobody can hold your money, but the tier 3 also recognizes that we are members of associations. We are members of companies. And so every company that you join has a vesting rule. that should apply. If you don't have one as an association, you can always contact us. We can help you design one. And that will clearly state the times that you can withdraw. But know that if you are withdrawing below 10 years, you pay a 15% withholding tax. Thank you.
Thank you. Let's come to chat and then go back to the hands raised. What's asking? Are there risks of protection for tiers 1, 2, 3 against loss of investment from the trustee? Maybe tiers 1, 2, and 3. Maybe that's what we must find out.
Okay, so for tier 1, it is guaranteed by government. So any money or loss of funds or anything that is done by a SNIT, government will step in to pay. That's why it is a defined benefit scheme. For tier 2 and tier 3, the security that we've offered, is because of the 4 people that are in charge to help you manage. So there are a lot of layers in it. For example, for investments, the law allows us to do a maximum of just 5% with a particular issuer. So for example, if I want to buy an FD, that's a fixed deposit or a fixed term deposit with, let's say, GCB, I can only invest as much as 5% of the total portfolio with GCB. If I want to do with Stanchart, I can only do a maximum of 5%. If I want to do with, let's say, DataBank or EcoBank EDC, I can only do a maximum of 5%. That is some of the ways that they. But the thing is, that is a way to minimize the risk. But any risk that comes, it is borne solely by the contributors. Because for the tier 2 and tier 3, every interest that comes or returns that comes to the contributors, and every risk will come to them. But the law is structured in a way that they are protected both in the management and in the investment of funds. Again, as I mentioned, and what I'll show you in the subsequent slides, there are specific investments that we are supposed to do by the law. And those investments, the reports we send to MPRA or the regulator every single month. So if we do any wrong investment, it doesn't take more than 2-3 months for them to find out. And so every risk that comes to the portfolio, it is managed in a way. And pension funds by law, if even the institution goes down, pension funds by law are supposed to be the first monies to be paid. So in the law, they are covered by the law that in case of default or in case of solvency, pension funds must be paid by whichever institution takes up. For example, when the banks were collapsed, Premium Bank, Unibank, Sovereign Bank, and the rest, CBG was created as a consolidated Bank of Ghana. Now, CBG were established, got their funds and all that. Reconciliations have done with the fund manager and the corporate trustees, and the monies have been paid. Some are still there, they are still there, but the monies will be paid. So even though it's been a while since 2019 or so, the monies will surely come back to the portfolio. So there are risk. Once it's investment, there will always be risk. There will always be risk. But we try as much as possible, both the service providers and the regulator, to minimize the risk on the portfolio. Thank you very much.
All right, thank you. Another question from the chat room. What are the benefits of tier 3 over normal investment like data bank and money fund and fund?
Yes. So again, I mentioned that the data bank and M-Fund and all those things that you have in the market, they are regulated by Securities and Exchange Commission. Now, the first part of it is that they are not regulated in terms of the kind of investments they can do, like they do with the pension schemes. So for pension schemes, in my slides that I'll share with you later, you see specific areas that we are told to invest. So if you take, let's say, 2019, there, but when men's gold and other Bitcoin and things went down, microfinance and things, there were some fund managers who were placing monies with those institutions. They were there because nobody regulates where they put their money. And remember that most people who put their monies with this, they want higher return. So they took the risk to do that. And we all know that the higher the risk, the higher the return. So if you want more return, you should stand for more risk. So they went and did some of these things. And when those companies collapsed, we all know what happened. Even those who suffered revocation of licenses, like the Gold Coast and First Bank and all those people, we all know that those who invested with them have not been able to retrieve either all of their money or entirely. They've not received anything. So if you invest with those institutions, fine. The returns, what we do and what they do is not so different. You might get something more or you might get something less. Even currently, because of the way the, how do you call it, the market is turned and a lot of people are defaulting and the market is, most of them are struggling to even keep up with the returns because a lot of their portfolio has been affected. So the returns that you were enjoying before, now you will not get it. Now, for the tier 3 fund, it is run like a mutual fund. But the thing is that for every single investment that is placed for you, it is under a guideline given by a regulator. That is the first one. 2, because we know that our returns and all those things, we send report to MPRA, and MPRA checks everything that is doing, what we are doing, the kind of place we put our money and all that. You need to do better because when they are ranking the list of trustees, you will be down there. And even because for us to, we have options for people to access their statements online and all that. People can always check when their fund is doing well or not. So the first thing is that you have security in terms of if the company goes down, you can still get your money with a corporate trustee or the tier 3 fund. But if you do it with a fund manager, if they revoke their license, you'll be part of the Gold Coast people. You also go to news and talk, but nothing will happen. For trustees, you are secure. With regards to returns, yes, trustees don't take a lot of risk. And so the returns will not be as significant as what you expect because we don't do microfinance and those risky investments. We do, if you want to even invest in the banking sector, it's just commercial banks, licensed and approved by the Bank of Ghana. We don't even do savings and loans. That is there. So the thing is, in as much as people want to see 30% interest, 25% interest, and they are happy, they should also be concerned about the risk. Most of us don't look at the risk. But corporate trust, we even have people in-house that assess risk. And so that is the benefit that you get when you are doing a tier 3 fund. And know that it is also under law. And so if even the entity goes down, the law will make sure that your money is refunded to you. Thank you.
All right, thank you. Let's go some hands which are raised. Mr. Setedwedi, please, can you unmute and ask your question? Please, can you go ahead? Please, can you unmute and talk?
Yes, please, can you hear me?
Yes, we can hear you. Yes.
Currently, our tier 2 contributions always in our arrears. What I want to know is that, is there anything that we are losing out? And if that is the case, what remedy can be taken by we workers? And another thing too is that with respect to tier 3, if you start with a particular percentage, along the line, is there any chance for you to readjust it? Thank you.
You're welcome. Thank you too for your question.
Okay, so just like I mentioned, the tier 2, if what I mentioned, there's a timeline for contributions to be paid. And if it's not paid, 3% penalty per month compounded is supposed to be paid on your behalf. But this, we all know we are in Ghana. If you're working for Ghana Health Service, I'm tempted to believe that your salary, it comes from controller. And from controller is government. If there's a delay of your contributions, there is no way you can summon government to court. It will not work. Even though the law states that if there's a delay, you should be able to get 3% every month compounded on your money. Because you are working with a government entity, it's very difficult for you to do that. I hope I've answered your question.
Okay, thank you. There's a question here on the chat room. At what period can someone start with mortgage benefits?
Okay, so the mortgage benefits, you can start at any time. But you and I know that the mortgage amounts or the amounts required to acquire a mortgage in Ghana is way more than what we are contributing in our pension. Most of us, when I get to the statistics part, you see that over 53% of pension retirees earn less than 1,000 CD monthly pension with SNIT. 53%, that's more than half of workers in Ghana earn this. And if we even take the Ghana Laboratory Association, On the average, probably the salary may not be 5,000. And you and I know that if we are doing a mortgage, which a house is costing, let's say $200. Now, $200 in Ghana is almost 2 million Ghana cedi. Now, if you ask yourself, how much, if we are even trying to service a mortgage of 2 million for an apartment that you are going for, looking at the exchange rate and all that, can the 5% of your basic salary cater for that? So as for the market, there are mortgage companies or houses in Ghana ready to accept this. But looking at the portfolio and what we are contributing, there is no way majority of us can get. Probably less than 5% are those who can access the mortgage. Because if your mortgage payment is 5,000 Ghana cedi, more than 95% of Ghanaian workers cannot afford. So even though the law is stating that we can go and get mortgage and use our this thing to finance or as a collateral for that, you and I know that we cannot pay that money. And so even when a mortgage company sees your tier 2 statement, there's no way they will give you that mortgage. Thank you.
All right, thank you. A question from the chat room. What if you work for 15 years and travel? Will you be paid pension when you are stay years and back to Ghana?
Yes, you'll be paid. And it's need to pay you your full pension, but you get a maximum of 35%, like I showed here. A maximum of 35% because you've done 15 years. So they'll do the average annual salary for your 3 best years of your working life. So they take the 15 years, put all the annual salaries that you've earned for the 15 years, take the 3 best years from it, and then they strike an average. And then that you get 35% of that money annually. So that one, after they've done the 35%, they'll then divide it into 12. And the 12 is what they'll pay. So if, let's say, your average salary was 1,000 cedi, and you work for 15 years, that means they'll pay you 35% of that 1,000, which is 350. And 350, normally, they have to divide that 350 by 12, which is even lower than, I think, it's around 30 cedis. But we have what we call minimum pension payments in Ghana. So you will be on the minimum pension, which I think is somewhere around 250 or so 300 cedi a month. So that is what you'll be on. So you can come back, but when you come back, SNIT on a monthly basis is the best they can do for you. Thank you.
All right, thank you. A question for the chat room. Can I join the informal sector if my boss isn't paying my SNIT, or I can pay any amount from my salary as SNIT contribution?
As for, if you said informal sector, right?
Like if there is not being paid monthly, let's say SNIT.
But the worker, is he working at working with you and also doing informal sector, or just informal sector?
Like in case he doesn't pay, can he pay himself to join the informal sector? Yeah.
Yes. That's why I mentioned the tier 3 or the new 3-tier pension scheme allows informal sector workers to also contribute towards their pension. So you can contribute to SNIT, the 13.5%. Then you can as well pay 5% even to a corporate trustee. But we mostly advise that doing that 5% to corporate, rather do the personal pension. That is the post-tax personal pension. So that one, you are not paying it before tax. You are paying after tax because it's money that you've gotten after you've received your salary. So that one, anytime you are coming for it, nobody will charge you a 15% withholding tax. But if it's deducted at source and your money is deducted before you pay tax, then we are compelled to charge you 15% tax. So if you want to do something on the side, which we advise, you do it post-tax. And that will be personal pension, tier 3 personal pension. And that one, you can do that to enrich or increase the value of pension money that you get in the future. Thank you.
Thank you. The question here, is there any software for calculating statement for the tiers 1 and 2?
For the tier 1, I already explained that it's a formula with SNIT. If you go to SNIT website, you will even find it there. If you go to the law too, it's there, stated clearly. It's there in the amendment, and in the old one, it's all there. For tier 2, because it is you are part of a mutual fund, which is invested in several asset classes. When I say asset classes, we have Government of Ghana securities, we have fixed deposits, we have local government securities, which I'll explain in the subsequent slides though. But I'm just giving you an introduction to them. And so it's done in several, but we have 2-year bond, 3-year bond, 5-year bond, a host of them. And all these bonds are running at different interest rates, at different computations and all that. So it's an active portfolio which is being done on a daily basis. Investment is done weekly and monthly and all that. So it's not something that we can tell you, say, okay, your interest will be 20% or 15% or 20 or 30%. No, it is something that works. It's a portfolio that has a total amount in there. Everybody has a share of the portfolio, and based on the price of the fund, you'll be able to calculate your return on the portfolio. So we can only tell you the return over a period, but we cannot just give you guaranteed return that this is what you're likely to get. I hope I've answered the question.
All right, thank you. Someone's asking whether you can recommend any fund manager for the tier 3 contribution.
Yes, the company I work for is Pensions Alliance Trust, and we manage tier 3 as well, and personal pension. So once you are done, my contact is with the association. I will send a form to the association. Anybody who is willing to join will just complete it and add a copy of their national ID, and we'll take it from there. It's a very simple process.
Okay.
All right. So can we stop the questions for now and then continue with the slides so that later when we are doing the second part, then we will continue. Thank you.
Let's take it. All right. Thank you.
Okay. All right. So I'd like to continue from where we left off. So now I'd like to discuss what we call enrollment form. Now, under the tier 2, tier 3, and all that, I believe even SNIT, when you go to SNIT to do your get your SNIT number and all that, SNIT gives you a form to complete, which we call enrollment form. Now, on this form, you are required to provide your full name, your date of birth, your permanent residence address, your telephone number, your mother's name, your father's name, your hometown. All these informations are taken from you because we want people to track you when probably a claim is due. We also ask for what we call beneficiaries, and which is most important in all of this. And beneficiaries are people that you will select that in case of your demise or in case of your death, they will be able to access your pension. If you fail to put people there, what will happen is that when you die, your family or whoever is coming to lay claim to your money will have to submit a letter of administration, and this is costly. The last time I assessed one, I think it was about 500 cedi. So assuming that even the money that you have is 1,000 cedi, now you are causing your people to pay 500 cedi to do letter of administration, which obviously is not typical because when you do it, it must go to court. They will come and paste it at your family house for 21 days before the court will rule on it for you to even get it. So it takes a bit of time. It can take like 3 months. Assuming you have a mother that is sick, or God forbid, or you have a child whose school fees must be paid. Once you fail to complete your beneficiary side, you stand a chance of pushing your relatives or friends through this ordeal. Now, once you've completed your enrollment form, you add a national ID. For now, is the Ghana card, which we all know that what government is pushing for. Now, after you are done with this, whichever trustee that or SNIT or whoever is working on your pension is supposed to give you what we call membership certificates. So from here or after this discussion, please, on Monday, or if you know you've not completed an enrollment form for a trustee that holds your money, I'm pleading with you to call them, look for their number, call them, tell them to send you a form and fill it. Add a copy of a national ID and make sure they update your records, because most trustees now have an online portal that you can go there to even check the information that you have, they have of you. Membership certificate is supposed to say which gives you, which concludes or finalizes that you are a member of a scheme. Most of Ghanaians are not interested in this and they don't even know. So they are just there and they are contributing and they don't even know where their money is, not to even tell their wife and their kids. Now, apart from this enrollment form, we have what we call service deliverables. And by this, I mean that for whichever place your monies are taken to, the first thing is that that company is responsible to you. And that if in case of any, like when you mentioned that sometimes our contributions delay and even maybe for this year, maybe the last contribution would have made to us is, let's say, January. It is left to your corporate trustee to do a follow-up on your contributions. Make sure that the monies are paid. If there are any penalties that they need to apply, they need to do that. That is on the corporate trustee. So you need to expect that from your corporate trustee. Don't sit back and be waiting for the money, because know that the tier 2 and the tier 3 are defined contribution schemes. And so what you put in, the time you put it in, all reflects into the income you get. Assuming there's a company that pays their money on the 1st of August, and your association pays on the 31st of August, what it means is that the Ghana Laboratory Association have lost all the interest that will come on your money from the 2nd to the 30th of August. So it's always advisable that your monies come in on time or earlier, so that you stand to get more on or interest on your money. Now, secondly, we also have to make sure that we get what we call members. The law states that every corporate trustee, both SNIT and your tier 2 and tier 3 people, are supposed to send you statements once a year, once by law. Some we do it quarterly, some we even send it monthly, and now we even have a portal that you can access it anywhere you are. So you don't need to wait annually, because we want you to have access to your money at any point in time. The amount that you have with us and how it's fair. You need to be able to know this. Now, again, the corporate trustee is expected to keep accurate record of your contribution. So if you go to your corporate, they are supposed to have record of when your first contribution came, and this one starts with your employer. If it is controller that is paying, or the payroll at Ghana, so we're supposed to have full record of all the contributions they've paid for members since they started pension in Ghana. Every month you send the payroll, wherever you have to. If you have to keep it online in a Google Cloud or any place, Google Drive or any cloud or whatever you need to keep it, try and keep it, because pension data is the most important part of the thing. And now, for lump sum benefits too, that is when you are assessing your benefit. The law says that it must be paid within a period of 30 days or 1 month. So if you claim to make your benefit and you submitted all your documents, it is expected that your money should be paid to you way before. We at Pension Allowance Trust try to do it within 48 hours. If we have everything ready, we pay within 48 hours. Sometimes you can even get it the same day, depending on when the funds that are on their account. The next thing I would like to touch on is assessing your tier 2 and tier 3 benefit, but I'll make it purely tier 2, because tier 3, it is free, you can withdraw. So for tier 2, even though we are taking the tier 2 money and it's for retirement, the law states that there are 5 conditions under which you can withdraw. The first one is compulsory or voluntary retirement. Compulsory or voluntary retirement. Compulsory retirement in Ghana is at age 60. All of us will retire one day, and so it's expected that we take our pensions seriously. Most people at Ghana Laboratory may not even have seen one statement from a corporate trustee before, and they are okay, they are there. It is now that you find that the people, when they are 58, 57, 59, before they will come and they're asking for their pension contribution. There are times when they are even missing contributions in your statement. But because you've not checked before, it is when you are going to retirement that you notice a contribution that was paid in 2014, May, didn't even appear on your statement. Imagine that your pension is, your retirement is due next month. How do we get that money from controller to be paid? And know that that money has lost value too, because if you had received that money some 8 years ago, it would have been better for you. That's compulsory retirement. Then we also have voluntary retirement, which is age 55. So if you're working and you feel like, I'm tired, enough of all this, I want to proceed on retirement because I have enough to feed on. Age 55, you're allowed to go. For tier 1, you will not get your full pension because you are going voluntarily. For tier 2 and tier 3, we pay you everything that is in your account to go on voluntary retirement. That's the first one. Now, the second one is that if something happens to you that you are not able to work anymore, the law, that one, it doesn't matter what age you are. Once you're a contributor to the SNIT pension scheme or to tier 2 or tier 3, the law allows that we pay you something. For SNIT, that's the Social National Insurance Trust, that's Social Security. That one, which I'll show you subsequently, the law says that if you have contributed for a minimum of 12 months, within the last 36 months, again, I repeat, you've contributed for a minimum of 12 months, within the last 36 months, if God forbid something happens to you now and you cannot work, both physically or mentally, you cannot be in employment and earn salary, pension is supposed to be computed and given to you. So every month, SNIT is supposed to pay you something. As for tier 2 and tier 3, because it's not defined benefit, we only can give you how much you've contributed together with your interest that has accumulated on your behalf. That's incapacitation. The third one is what we call unemployment at age 50. If you are unemployed at age 50, the law says that you can assess your tier 2 contributions, but you need to provide what we call an unemployment certificate. This one, you provide this by going to the Labor Commission, the National Labor Commission, together with the NPR. So you write to us through NPRA, and it goes to the National Labor Commission. Then they will write through NPRA to us that you are unemployed and you want to assess your pension, and then we will pay you whatever is due you. But note that once you've assessed this money, you are declared as partially retired. So you cannot go back and be trying to get a job or try to fool the system. It is criminal and it's illegal. Now, the fourth one, which God forbid, none of us want to get that news, or none of us want to suffer, even though it's inevitable, is death. Death, none of us know when we will die. And so those at the health sector, you know, you understand it better than some of us. And so we always advise that you need to make sure that you have protected your beneficiaries. That's why I mentioned that try and fill the enrollment form, call, get it. If you've even completed an enrollment form, call and change the beneficiaries if your status have changed. If you were single and you put your mother and your brother there, and now you are married with kids, call SNIT or go to their office, complete a form and change the beneficiaries for the sake of your wife and future kids. If you don't want to, it is not by force, because at the point of death, we will only take what you have. And that's what we use. We will find out that your mother there is the beneficiary plus your father and your brother. The law doesn't look at your children. For SNIT, for them, they'll use the interstate succession law. And that one states that if you have any kid below the age of 18, we should pay 60% of that is SNIT. So SNIT will look for that child if it's available, and they will pay 60% of whatever SNIT contribution you have to that child. But the rest of the 40% will be given to whoever the beneficiaries are on the SNIT form. But for tier 2 and tier 3, we don't work with interstate succession law. We work with an enrollment form by law. So whatever you put on the law, on the form, that is what we will pay to. So if you don't write your wife and you write your girlfriend, or you write the maid in your house, or your teacher, or your friend, or whoever, that is the person we pay to. The fifth one is foreigners that are working in Ghana that are permanently emigrating from Ghana. So if you're a foreigner and you're working with Ghana Health Service or the Ghana Laboratory Association, and you are living in Ghana permanently, you are allowed to access your pension and go. As to whether when you come back, the law will require you to start contribution again, the law doesn't state that one. All right. Now, this is what I mean. The invalidity pension is what I call the incapacitation. So as I mentioned, you have to have done 12 months within the last 36 months. Then the survivor's lump sum is what I mentioned to you. Dependents must be named as beneficiary. That one, so I've mentioned that one. And then the next one was the 50 years if you are unemployed. Now, the next thing I need to add is for the medical incapacitation, you need to be approved by a medical board, a competent medical board, which will be vetted by the regulator that truly you cannot work. And they've certified that you cannot work before you qualify for the invalidity pension. Now, the next thing, this one, so I think I mentioned it earlier. The section 102 of the Act 766 states that the tier 2 benefits cannot be attached in execution of a judgment debt or used as a charge or pledge. So that means that you cannot promise anybody. So if the association goes to work with a bank and promises the bank that, oh, the workers do tier 2, so you can pledge, you are pledging this, and they even fill form to that effect. If the worker defaults, there is no way the bank can get that money from the corporate trustee. There is no way. The law do not allow that. It is the tier 3 that the law allows. Now, again, with the mortgage, we've also mentioned that it is acquisition of a parent, so I'll skip that one as well. Now, there's an important part which members are not aware of, which I'd like to touch on for education of all. It is what we call the temporary pension fund account. temporary pension fund account. Now, this account was set up by the MPRA in 2010. You know, I mentioned that the new Pension Act was enacted in 2008, but it started full operation in 1st January 2010. 1st January 2010. So, but the licensing and approval of corporate trustees, that is the private institutions that will work on the thing, their licenses were approved in 2012. So between 2010 January and 2012, majority of the people who were working, or most people here who are above the age of, or were working within 2010 and 2012, most of them will not have their contributions with their corporate trustee. I repeat, those who were working with, as at 1st January 2010 to December 2012, most of them will not have their contributions with the corporate trustee. And so those monies were paid to MPRA, which was given to Bank of Ghana to invest. Now, in 2012, after the corporate trustees were established, now they started the negotiations and discussions to move the monies that were given to Bank of Ghana to the corporate trustees started. The trade union and other organizations started the discussions and all that, but the monies were not paid. The agitations were there, people on the streets and all that. Those who listen to news and follow things in the economy would have known this story. So what happened was that finally in December 2015, or largely in 2015, those monies were paid. So all those who were working during that time, if you take your tier 2 statement, check for TPFA contribution and TPFA interest. This tool is supposed to give you that money that you contributed from 2010 to December 2012, together with the interest that was paid on the money. Together with the interest. So this you're supposed to see on the statement. Again, I mentioned that when you take your statement, one, check the receipt date, check the month that the contribution was paid, and check the amount that was paid on your behalf. Make sure that amount is 5% of your basic salary. 5% of your basic salary, not your net. 5% of your basic salary. And then now I'm adding that check what we call the TPFA. Now, this TPFA money, after 2015, when those who were with the corporate trustee, we wrote to the regulator and they sent the money to us. Those who were not working as at that time. Yes, hello. I don't have that here.
Yeah.
Can you see it now? All right, sorry for losing you earlier. Okay, so as I was saying, for those that have, for those who didn't have a corporate trustee to assess their TPFA, their monies have been lodged with Gen Trust in the Sankofa scheme. So if you were working from 2010 to December 2012, and you've not had you don't have the TPFA on your statement, kindly reach out to your corporate trustee to help you get that from Gen Trust. Now, the second thing I would like to touch on is what we call the amendment, the Act 883, and this is for people that are close to pension, those who are 55, let's say 58, 59 above. Now, when the new Pension Act was enacted earlier, starting January 1st, 2010, what happened was that the law said that exempted those who were 55 years and above. 55 years. So that means that the rest of us who were 54 and below were joined the new pension scheme, whilst those that were 55 and above, as at January 1st, were asked to continue with SNIT. So for them, SNIT still paid their lump sum and all that. But somewhere in 2014, an amendment was done because people were still complaining that the money they are receiving from SNIT is very small. And so an amendment was done, which then reduced the age from 55 to 50 years, and again made it optional. So then now, first they said 55 above, compulsory, don't join the new pension scheme. You don't have to work with any corporate trustee. But now they've made it anybody above 50 years, feel free to join the corporate trustee. That means that the tier 1 will go to SNIT, your tier 2 will come to your corporate trustee, and when you go on retirement, your lump sum will come from the corporate trustee, and SNIT will only pay your monthly pension. Now, for those that move their monies from tier 2 to tier 1, there are some who were like, no, SNIT, if you were listening to the news somewhere 2019, 2020, it came up that those who had all of their money with SNIT, SNIT was paying them more. And those whose part of their money was with the corporate trustee, SNIT was reducing their money, the money that they were paying to them. And this was supposed to disincentivize them from contributing to a tier 2. Now, what happened was that for anybody who reaches out to a corporate trustee, the maximum amount out of the 5% that can be transferred to SNIT was 4%. Now, let me explain this. This was because for those who have been in the pension industry for long, before, we used to contribute 17.5% of our basic salary to SNIT. 17.5% of our basic salary to SNIT. When the new law was enacted, they said that the contribution money was small because SNIT was saying that because they received just 17.5, that's why they cannot pay big pension money. So the law said, okay, let's add 1%, which was shared between the employee and the employer. So first, the employer was paying 12.5%, the employee was paying 5%, making 17.5%. Now, the new law stated that employers will now pay 13%, that's an additional 0.5%, and then employees will pay 5.5%. So that is the 1% that is on it. So this 1%, up to now, the law has not ruled on that. So if someone says, okay, I want SNIT to pay everything, both my lump sum and my monthly pension, the law allows us to send 4% to SNIT. The 1% is still here, or with the corporate trustee. So when you are due for retirement, that 1% is paid to you. Okay, so we can quickly take another 10 minutes or 5 minutes for questions before I take you through the investment guidelines. Thank you.
Thank you, Mr. Baxton. Okay, there's a hand up from Mr. Emmanuel TV. Please kindly unmute and make a contribution.
Yes, good afternoon. Thanks for the presentation thus far. I wanted to ask, considering that the SNIT is operating based on laws, when they run into difficulties, or the government, who is the main funder for SNIT, in the event that SNIT defaults, isn't it feasible for them to just go back to Parliament and then make laws to either reduce the amount that SNIT was due as a mitigation strategy for not able to meet the obligations that is due retirees? Just wondering.
Okay, so this wondering is same. We share in the same destiny, but you see, even for SNIT, SNIT we all know, even though it is a state-run company, even now it's a parastatal or privately managed, even though it's a government institution. What is happening is that Social Security is supposed to have a guarantee by government. Social Security is supposed to be, if everything else goes down, you need to have some level of Social Security from government. Now, SNIT government also needs money that comes to SNIT for development. It is not just about payment of retirement benefits, but also government also takes money from SNIT for the development of the country. If it's about roads, it's about hospitals, it's about schools. Government takes money from SNIT to do that. And so the contributions that we pay to Tier 1 is not that it is left to SNIT to decide. You know, there are a lot of projects that SNIT embarks on, which a normal private entity will not do that. For example, if they want to extend electricity to a remote area in Brongahafo or the northern part of Ghana, I believe a private organization will not be up for it, because probably those people only need light and maybe a radio. So it's not something they will do. But for SNIT, because it's a government institution and it's for Social Security, SNIT can go ahead. Again, like I give you an example, for someone who is earning 200 cedi a month, if the person is going on retirement, if it is 35% of even that 20 cedi or that 200 cedi, if whatever computation we do, that person will earn below 300 cedi. But the law is also has a way of coming in, because it's government owned. The law can state that, okay, 300 cedi is too low, so the minimum pension, even though your contribution calculation is 250, the minimum contribution you get is 350. It is some of these, you know, interventions that government comes up with is the reason why government plays a role in the SNIT. Also note that government also, most of the investments done by Tier 2 and Tier 3 are in government bonds. Now, if somebody wants to go and do any investment, people are looking for treasury bill to go and buy. Who owns the treasury bill? It's government. So it's like government looks like the sole guarantor of everything. So SNIT, even though we all love to have that pull out or reduce the money that goes to SNIT, based on certain things, like, because if you read the news somewhere last year or so, SNIT came up that if they don't do something about the inflows that come to them, somewhere by 2035, they will not be able to pay pension, because to them they first say the 13.5% that come to them is way too inadequate. That is what they are even saying. And so they are even asking government to increase the money. Again, if I take you back to the law, the old law before we had the new Pension Act, when you work for 20 years, the law guaranteed you to get 50% of your money, 50% of your money as guaranteed. So if, let's say, you see that the new one has said 35%. In the old law, it was 50%. So when we reduce the money that SNIT will take from the 17.5% to 13.5%, SNIT also changed this part that we too will not be getting 50%, but we will get 35%. Again, from the 1.5 that I mentioned, there's 1.5 on my slide here, the 1.125 initially used to be 1.5%, and that could have given you 80% maximum pension right, as you see on this slide. But because they changed the new pension law, SNIT is receiving less, SNIT changed the pension right to 60. So anything that you want to impose on SNIT to reduce something, be rest assured that it will come back to us as a reduced pension money. And so what we can only advise is that for SNIT, SNIT is there, it's government. There is no way any of us can push that thing to happen. The best we can do for ourselves is to start contributing to Tier 3. Start contributing, which I will tell you or will discuss in subsequent slides. Thank you.
Thank you. You have a hand for Mr. Ernest Bedu Boatin. Please kindly unmute and.
Hello.
Yeah, please, we can hear you.
Yeah, thank you very much. Mine is not actually a question, but I think a colleague asked a question that our presenter maybe skipped. He asked what happens to those of us who were contributing to SNET before the new Pension Act came, what happened to the money that we contributed to them? I think the answer I would like to support the presenter with is what we call the past credits. So all of us who were working from whatever year to December 2009 and then 2010, the new Pension Act took effect. All the money we converted to SNET. Actually, the pension fund manager wanted that money. But Smith said if they pay that money out, Smith will collapse. So Smith rather invested that money with tax credit. So whenever you go on pension, Smith will pay you that tax credit as a lump sum before they pay you the monthly pension that they pay to pension. So let's take note of that. They actually invest that money in government credit. So whenever you take your Smith statement, that tax credit is reflected on that statement. You can actually check how much your tax credit is by the month and by the quarter and by the year. That's what I wanted. Thank you very much.
Okay, thank you. There's an earlier hand raised. I don't know whether the person doesn't want to. It's okay with the contribution so far. Okay, for the chat room, is it advisable to have just a single beneficiary?
Okay, is it advisable to have a single? For that one is you. Just like I mentioned, a beneficiary can also die just like you. So if you have one in there that, God forbid, maybe that person too goes, probably at the same time you also go, then it looks like the money is there, but nobody can access it unless maybe someone brings an early. That's the letter of administration. So we advise that at least, but it's left to you. You have your everybody has what they want to do. You can give 100% to someone younger than you who you believe that probably will to leave you or something. It's a choice. It's a choice.
Okay,
it's a choice that is left. Yeah.
Sorry, please can continue if you want to. Yeah. Okay, thank you. Then let's have Mr. Wisdom. Please kindly unmute and please unmute and make a contribution.
Okay, thank you very much.
You're welcome.
And good afternoon to the House. So my question is, will you advise that as an association, GAMS, GAMS, medical lab professionals, medical lab scientists across the country would have a tier 3 and then help us to be able to manage it properly? So I would like to know if you advise us as laboratorians in the country to have a tier 3 as one, and then have a very good fund manager, and then have the entities that will manage it and for us properly. Yeah, so that's my question. Thank you.
All right, thank you.
Yeah, thank you, Wisdom. So this is what I've been saying since we started the webinar, that the tier 2 and tier 3 will never be enough. And for an association or for an employer, what you don't want to see is members who work with you or former employees go on retirement and suffer. It is not a good thing to behold. And so what we advise is that it should be of interest to the association that even though salaries might be low, or even though members feel that the economy is the price of goods that keep rising and all that, this will never change. Even at retirement, it will be way worse. And so they need to sit down, look at how much reasonably will be enough for members to contribute to, and you start contributions as soon as possible, because that is the only way you can shore up the pensions or retirement money that your association members will get when they go on retirement. I believe most of your members will be young, and so they have a lot of years ahead of them. And so if you can start now, it will be of benefit to them. For those who are getting closer to retirement, what they can do is they have to increase the amount so that at least they too can earn something significant when they go. This I will show you in the next couple of slides. Thank you.
Thank you. The question from the chat room says, if a person contributes to SNAIT for 3 years and travels outside the country, can a person still contribute to SNIT whilst working outside?
For SNIT contribution, the law do not limit where you are and all that. You can even, once it is an established account, you can do it wherever you are. So that one, you can do it. You can do it wherever you are. Once you are paying the specific percentage, SNIT will take it on your behalf. Thank you.
All right, thank you. Savidon, do you still want to talk about the old hand that series?
Okay, so if there are no more questions, then I would like to continue so that we can pause after that too, and then we can take all the questions to the end.
Okay,
thank you.
Welcome.
Okay. All right, so the next thing I'd like to touch on is the new MPRA investment guidelines. And like I stated, the investments or corporate trusts were licensed since 2012. We've gone through different reforms. I think this is the third one. The first one started from 2012 to I think 2017 April. It was changed, and then this new one started last year September. And so the old is in the past. I'll focus on the new and give you the implications on the portfolio as well. Okay, so the new investment guidelines, just like I stated, has clearly states the various asset classes that you can invest monies in. The first one is what we call Government of Ghana securities. And this one is the normal treasury bills or treasury bonds that we all know. The 2-year bond, 3-year bond, 5-year bond, 15-year bond, 6-year bond, and all the bonds that we all know. We can do a maximum of 75%. Now, on the right side, you can also see percentage of AUM per issue. That means that for government is a single entity. So for them, the law do not ban you from doing it. That's why it's non-applicable. So you can put all the 75% money with Government of Ghana. Then we also have what we call local government and statutory agency securities. This one, what the portfolios or the securities under them are ESLA. ESLA is the Energy Sector Levy Act bond, the one that was introduced in 2017, also 2017, to help finance the energy debts that we had in Ghana. So that one is what we call the ESLA bonds. Again, we also have in the cocoa bills that is issued by Bank of Ghana, but on behalf of Cocoa Board. So that's cocoa bills. We can do a maximum of 25%. Then we also have corporate debt securities. These are securities issued by private entities listed on the stock exchange. When I say stock exchange, it's a market where companies go to raise funds. But the technical definitions, you can always get it online. But for now, for the purpose of this training and education, we want to limit it to any private entity, be it Bayport, Leshego, and Eastway, and the host of them that people know. They come as and when to issue bonds on the stock exchange. And these bonds we are allowed to buy part of. The law allows us to buy a maximum of 35%. But like I mentioned, because of the risk associated with some of these securities, the law allows us to do a maximum of 5%. Then the next one we have is what we call listed ordinary shares or non-redeemable preference shares, blah, blah, blah. This one is stocks or equities. So for those who know the Ghana Stock Exchange, we have stocks in the market. Recently, MTN issued stocks that some of you might have bought at the price and all that. The law allows us to do a maximum of 20%. Then we also have what we call bank securities. And these are largely fixed deposits with commercial banks. And this one we can do maximum of 35%. We also have what we call collective investment schemes. And this one are mutual funds and unit trust. This is the EcoBank, EDC fund, mutual fund, data bank, and fund, those things. They all come under collective investment schemes. You can do a maximum of 15%. Then we have what we call alternative investments, and this was a new thing that was introduced last year. And this is supposed to take care of private equity investments, real estate fund investment, and all that. And that one we can do a maximum of 25%. So that is it for where you can invest your money. So as you all can see, we are guided by law to invest in these specific instruments. So at no point can I go and, or the company or a corporate trustee, put your money elsewhere. It is a breach of the law and we can lose our license because of that. And so, like I mentioned, this is part of the bigger picture. What makes corporate trustees safer and secured than investing with a fund manager? This has a second one, which is not being trumpeted enough. And that's what we call the constituent funds asset allocation. This is the new thing that NPRA has brought, that they expect every single Ghanaian worker to be part of starting 1st January next year. Now, what they are saying is that now, instead of having everybody in Ghana Health Service as one fund, in one tier 2 fund managed by one trustee, what they are saying is that now we are going to divide you into age groupings. And after dividing you, the investments will be done based on age grouping. So now what they are saying is that for those between 15 to 44 years, they are considered as moderately aggressive. 15 to 44 years, moderately aggressive. And for these people, the law is requiring that we do a minimum of 15% in stock market and alternative investment. When I say stock market, I mean investing in MTN stocks, GCB stocks, Standard Chartered, those stocks. We all know how the stock market is doing now. It's not faring good. Last year it did very well, but this year it has required losses of over 30%, up to 40%. So per the required, let's say for Ghana of 7, you can decide that, okay, for us, we are sticking with just a 15% minimum for those within that age bracket, but you cannot do zero. Currently, as it stands, even for our portfolio at Pensions Alliance Trust, the maximum equity we have on our portfolio is below 1%. And so next year, we are all forced to do up to 15% minimum for those between the ages of 15 to 44, which are a huge part of the portfolio. Then we also have those between the ages of 45 to 54 years. And for these people, they assume that they are close to retirement or so. So for them, they call them moderately conservative. And for them, they have to have a minimum of 5% of their portfolio in equities and alternative investments. For those between 55 to 60 years, that means those who are left with just 5 years to go on retirement, for them, there is no equity in their portfolio. And then there is a group of people who, for them, risk is their middle name. They always want to take risk. And for them, the law is stating that even though you want to take risk, write to us through the trustee. So write to NPRA through the trustee that, oh, for me, dear, I trust that stock market can give me 40% every year. So I want to do more equity. So instead of I'm 15, let's say I'm 25 or 30 years, instead of the portfolio being 50%, for me in quantity, I want to do 20% minimum. That one is by formal request. So this is what the new thing that has been given, and we are expected to comply. So come next year, most of you who are within the ages of 15 to 40 and 45 to 44, you start seeing declines in the money that you have on your retirement fund because probably the equity market is not doing well. And once we have that, that means that there will be an issue. And when you call, it is not the corporate trustee that is chopping your money. You should know that it is per the new investment guidelines. We, as an entity, we are trying our best to see how best we can engage the regulator on issues such as this, but we don't know how it will end. Yes, and that is just for the tier 2 fund. We don't know how it will end. So it is something that is critical that we need to all, as a group, look at it, see how best it will benefit our pension in the future. If it is an issue for us, we need to all gather as one force and then seek answers to this particular issue. Okay, so this is with the investments. I don't know if we have a lot of questions in this, or I should quickly run through the retirement planning and then we can take all the questions that follow. I don't know which one, Kenneth, you suggest.
Okay, we have some questions. All right, let's look at those questions. Then we can go to the last session of what.
Okay. Then,
okay, so let's look at. Okay, the one in the chat room. Okay. I is asking, when government pays 2010 to August 2016 tier 2 to our fund managers, when will they do it? Is that what is asking?
Okay, so like I mentioned, okay, if I may, like I mentioned, you see, public sector workers own is quite different and unique. Everything that has to do with you, even though the law captures what you can do and all that, it is government. It's the same government that wrote the law, and it's the same government who is owing you. So I doubt how you'll be able to fight for this. But the thing is that for those who have retired now, they are really struggling because most of them have not been able to access these contributions that we are talking, which I call the TPFE, or which we call the TPFE, Temporary Pension Fund Account. And so it is something that as an institution or as an association, you need to fight for. The executives is something that they need to push for. And the earlier you push for it, the better. It could take a year, it could take 2 years or more. But once you start, at least there's a better chance of you getting it in the next couple of years. A lot of people are old. Even for some of them, they don't even have the data on the contributions that were made on your behalf. So even when you even want to access, they don't even know how much is due you. But if the payroll officer or Ghana Health Service have a record of the people that they pay, they can then submit that data in addition to the letter to Gen Trust or to MPRA or to whoever you want to lay claim to. And I believe it will be worked on. So I would advise that you get the data first, write a letter to MPRA as a unit, as Ghana Health Service, Ghana Laboratory Workers or something, and then push it through. If probably the entire Ghana workers will not get, probably the laboratory scientists will be able to get yours. And it's something that you need to work on and work on fast, or else most of your people will go on return without that money. We have a lot of people, especially the teachers. Most of them are going on retirement, and all the monies they contributed from somewhere 2010 to about even 2016 thereabout, most of them have still not received their money. And even we all know how their monies are very small, but still, they've not received the money. So I advise that you take it very serious upon yourself. Let it be one of the main things on your agenda, and you push for it. Thank you.
Thank you. A question again. Is what if you are working with an old organization and currently not working there anymore? Can you still update your account and use it as a current account, hence, and enjoy the benefits?
If I got the question right, the participant is asking if you were working somewhere else, you've contributed there, but you've moved somewhere else. Is that what he's saying, or you have stopped working entirely?
He has moved somewhere. That's what he's asking.
Okay, so what happens is that's what we call the porting of benefits that I discussed earlier. So the new law allows you to port benefits, but you cannot access that, especially the tier 2. So you need to identify who your previous corporate trustee was with your previous employer, and then reach out to the new trustee of your current employer. So I believe Ghana Health Service or Ghana Laboratory Scientists, you have your trustee. For those who get their statements in their mail or get text messages, you know who is your tier 2 manager. So reach out to them through maybe the association or whoever is in charge. Get some of those things sorted, and then you do your porting. So the trustee will help you port from your previous trustee. You don't go to the previous trustee. You just have to work through your current trustee to help you get the money. Now, as for withdrawing the money, tier 2, like I mentioned, there are 5 conditions under which you can withdraw, which I've shared with you already. Anything apart from that, you cannot. It is specific for retirement. If there is no chop around that one, it's a tier 3 that the law allows you to withdraw. And that one too, you can do porting. Most people, what we see is that once they move from one entity to another, let's say they were working in Kolebu and they moved to so and so other facility and they have different PF or something there. Instead of them to do porting, they tell you today's money is sweeter than tomorrow. So they just write and withdraw their money and chop it, forgetting that tomorrow's problems will be greater than today's problem. Thank you very much.
Well, thank you. So I was asking whether the money that the fund managers invest in the government? It's not too high, the maximum amount allocation to government.
Okay, so like I mentioned, this is an investment guideline. This is not what the fund manager or the corporate trust. And again, I keep hearing fund manager, fund manager, fund manager. Yeah, let me clarify again.
Okay.
The work of tier 2 and tier 3 is largely done by the corporate trustees.
Okay.
For example, Pensions Alliance Trust. The fund managers work for us. The custodian bank work for us. So it's like the contract you have is between the employer and Pensions Alliance Trust or the corporate trustee. The fund manager, you don't get to tell the fund manager anything because it is, we do the appointment of the fund manager. I don't know if you understand me. Now,
yes.
based on what we call the investment policy. Now, out of this investment guideline that I've put before you, we have what we call an investment policy, which you can also work together with your corporate trustee to tell him what you want, what you don't like, after seeing what they already have. And then if you don't want to be part of their master program, that is the fund that every employer is under, they can always create something for just you. But you should note that once it is just used to, the returns that will come to you is not as much as those in the master, because an investment that has over 1 billion, the returns that it can attract is way more than an investment of, let's say, 40,000. And so what you see before you is just the guideline. You are allowed to play the maximum of it or the least. So for example, if I give you the portfolio at PAT, because government of Ghana is risk-free, at least for now, even though government is getting closer to, that area, we all know it's risk-free. No matter what it's government of Ghana, they will pay you. That one, the returns too are quite huge now. So we've done almost 75% now. Now, for local government security too, it is almost like government. Like I mentioned, the ESLA bond was issued by ESLA PLC, but it is guaranteed by government. So you know that even if ESLA defaults, government will pay. Again, ESLA has a, how do you call it? They've set up a fund for the levy that they take, the monies go into that fund and they use that one to service the investment. So you know that the money that they're taking from you, as they take the levies from the filling stations and the petroleum products, they will pay that, they pay that money to your account, you will get your money. So that one too is a big one. So to be on the safe side, most people do 75 and 25% to be secure. That means you're not taking any risk. However, corporate bonds also are in there. Corporate bonds, like I mentioned, are private issuers who there's a level of risk, like Leshego, Bayport and all that. We know their status and all that, but there's a level of risk. And because they are on the stock exchange, but there's a level of risk. So that one, even though you can do 35%, mostly we have done like about 4%. Note that that one gives more interest than even the government of Ghana security. So just like people are here, some are concerned about risk, their whole generation interest in just return, because someone will call them like, the person is like, government of Ghana is giving me 26%. Why are you telling me the return on my portfolio is 22%? The person has forgotten that it is in a portfolio that includes a lot of asset classes other than this. And the portfolio is working under a guideline with MPRE. So some of these things come in as and when to balance the portfolio. Last year, like this, the funds that had equities in their portfolio, the fund did almost 44% increment. No security in Ghana did 44% last year. So if you had a fund that had more equity in the portfolio, you're likely to make more in terms of returns. However, this year, as the returns that's lost by over 30%, this year too, your money will go down. And so what you are seeing here is the maximum that you can do, but there is a minimum that you can take. But for GOGs, the minimum is, I think, somewhere around 60% that you can do for GOG, government of Ghana. But the rest, the minimums are there. They are left to you to decide. Thank you very much.
Thank you. The question here, I think, can someone go to the Senate office to confirm if the employer is paying his or her contributions? I think it's obvious.
Yes, you see, the going to the Senate office is the traditional way of assessing benefits now. Now we don't, everything is online. So I advise that Senate is online. I remember even last year or last 2 years, they made a new announcement of statement sending and how we can access our statement with password and all that. Those who had renewed their enrollment form with them would have entered a new email address that they have in access, and they send you statements. Sometimes if you don't see it in your inbox, just go to your spam or junk mail. You'll find it there. Look at, you see your statement. Once you get your statement, it is month to month. So you can check for every single month that SNIT has contributed on your behalf. Your employer has paid. So if your employer hasn't paid, you can check from inception of when you started working till now. Everything is on that statement. So if you check it, you know. If you don't check and you wait till retirement, probably the company that you work for now might not be available at that time. Maybe they've gone away or they've stopped business. There's nobody to pay that money. So after the SNIT one, you can go to the office if it's close to you. But make sure that when you go to the office, enter your details in their system, get to complete that form, change your beneficiaries and all that, and be able to have an online access. Now, some of us can even check wherever we are. We can check it either on our web portal or just go to snit.org or something, and you can access that. You enter your SNIT number and your password, or your password we send to your email, and then you take it from there. So it's accessible. You can either go to SNIT office for the first time, make sure your entries are there and all that. Then from there, you can do everything online. Thank you very much.
Hello. Hello. Sebastian. Hello.
Yes, hello, I'm here.
Yeah, we couldn't hear you for a moment. So if you can, yes.
Okay, so what I was saying was that going to SNIT is okay, but that should be only once, because you are just going there to check your details and to complete whatever form you need to fill for them. But after that, you should be able to access whatever you need online. So tell whoever you meet at SNIT that you want to be set up, or how do you get set up online, so that going forward every month you can sit in your office or in your house and then just go online to check your SNIT statement. Some of us do that as often as possible, because we are in the space and we understand what it means to not have your pension paid on your behalf. Thank you.
Thank you. Please, you can go ahead with the rest of the presentation.
All right, thank you. So the next part is the most interesting part of all that we've done. The previous ones has been very technical. But this one is about what will happen, why you need to plan for your retirement. Why do you have to plan for your retirement? Okay, so the basic needs. This slide gives us an idea of what it is, the basic things we need. Maslow theory of needs: shelter, medical care, food, clothing. If you are not doing anything at all, after these ones, every one of us need it. Now, for when you are working, as you can see, it's colored yellow. Everything you can afford for most of them, even though some of us might be struggling with one or two, but even now we are working. We are working, but we are still struggling with a host of them. Now, when you check the right side, which is retirement, as you can see, shelter is red, medical care is red. That means that if you are in retirement, payment of rent will be far difficult than now. Payment of rent, I repeat, will be far difficult than now. So if now you are even struggling to pay rent, know that at retirement it will be further worse. Now, medical care, we all know that BP and diabetes and those hypertension and those things are associated with old age. Yes, some are fit and all that. And so even aside the financial planning part that I'm discussing with you today, there are health planning and all those things that you need to consider as part of what you are doing when you are planning for retirement. Your health is important. If your health is not good, and I'm even the one educating health people, sorry. If your health is not good, it is possible that all the money that you are accumulating in your pension might be used to service health costs. For food and clothing, is something that you can manage at retirement, or at least every day you need to eat to survive. Now, why do we have to plan for retirement? Now, the first thing I'd like to touch on is what we call low pension payments. Now, we've heard various stories about people leaving work, getting home, thinking that SNIT will give them 200,000, only for them to go there and get 10,000. We have teachers who have worked for 35 years, thinking that they will take the retirement money and go and build a house, only to be given 24,000 as their retirement money. Now, if we even take us now, I don't know which house you can build with 24,000 in this current Ghana. And so we advise that as you plan for your retirement and as you do a host of these things, please, as for your health and your shelter or a place to stay, try and also have that one at the side. Yes, we all complain, oh, the income is small, this is small and all that, but let's try, because old age poverty is far worse than young poverty. Now, the next point or reason why you should have a retirement plan is because it makes retirement great. We know of people that retired at age 60 when they went to SNIT and they got to know that their monies were 15,000. Because of that shock, they didn't even last 6 months and they died. Because when you look at the lifestyle they lived before, having to be able to fend for themselves, pay for their bills and all that, and you happen to be in retirement and you can't even afford to pay rent for your kids. For men, it is a struggle. For women, at least, society understands. But for men, it is a struggle. And so we always advise that you need to take time to enjoy some of the money, but make sure that your retirement is well catered for. The third thing is longer life expectancy. One thing you should notice that those who plan for their retirement, statistics have shown that those who plan for their retirement, they rather sometimes die early. Those who fail to plan, they rather stay longer. So if you have planned that, okay, I'm retiring at age 60, and you think, say, you die at 65, it might shock you that you die at age 90. And the question we ask is, from 60 to 90, that is 30 years. 30 years is, let me say, if I'm taking from 2022, that's like a lot of years behind. Some of us might have been in primary school or something else at that time, but we are here and we can remember the primary school days. That means that if the longer your life expectancy, the more money you should try to accumulate, or else it will be dangerous for you. The fourth point is what we call escalating health costs, which I mentioned in the previous slide. Old age comes with increase in health costs. The higher your money, some people can even access health insurance, private health insurance, to assist them in their old age. If you don't have money, there's no way you can access a private health care, which you need for your survival. Now, some also might think, say, okay, I'm strong and all that. When I go on retirement, I'm in the health sector, I can still get locum here and there to do. There's a possibility that you might not be able to find a job. And so that is why we should do that. And again, sometimes the energy that you get, you think you are feeling at age 55, maybe at 61. That energy, you will not feel that way anymore. The eighth one I'll talk about is what we call depending on children. In Ghana, we all know how it is. Fathers or parents are taking care of their children with the primary objective of you coming to take care of them. Yes, we are not against children taking care of them, but we always advise, but we tell them that for the children, try and put something aside for your pension. Some of us, or most of us here today, are even struggling to take care of or send money to our parents now. If today, Ghana, we are struggling to do that, I doubt if our children will be able to do that for us. So it is left to us to take it seriously. Now, we also have, currently now, we also have more, we are more nuclear than before. Before we stay at family houses, your extended family, uncles and aunties are all there. If you're hungry, there is always food in the house. Now all of us are in gated houses, gated communities. There is no place to get money from anywhere. No place. If you're hungry, you'll be hungry. And so it is, and imagine if now we are working and you are not even able to take care of these petty things. How are you going to do that when you grow old? And one thing we should also take into is rising cost of living. Today, just this year alone, price of things have changed rapidly. And so if, let's say in January, you were expecting to get $20,000, that would have given you $100,000. Now, if you have $20,000, that, okay, let me even do the reverse. If you have 100,000 cedis, that could have gotten you this much. Now, because the dollar has changed, you get far less, about twice less. So you should know that once you are growing, things are also increasing. Things are increasing. So we need to make plans on, if in your mind 1 million will be enough for you, then I'm sorry. Even though it's good amount, 1 million is good. Even now, properties in cantonment and East Lake and the likes are more than 1 million. Some are 5 million, 10 million, the likes, which some of us will never even dream of. So it is very important that we take retirement planning very serious. There are several ways of doing that, which I'll show you. But for now, for this slide gives us the retirement plan, what you need to have. There's a tier 1 that will give you your monthly money. There's a tier 2, which will give you the lump sum. And the tier 3 also will give you lump sum if you so wish. But there's also a fourth one, which we call the contingency plan or the personal pension. You see, most of us know only provident fund, but we don't take care of contingency fund. And that is what I want to preach to you today. For a contingency fund is a fund that, an investment fund that you are putting your money in to do some of this, your, school fees, rent, and some the basic things that you do. If you have to take care of your mom and all that, just some investment account to be putting money there, so that if, let's say, your child's school fees is due in January, it's not now that you are going to use your salary to pay them. For those who just married, or those who are planning to marry, or young in the association, or just started work, we always advise that start putting something away for your kids now. So that if you are even paying 100 or 200 every month, if you are marrying in 3 years or 5 years time, at least you have enough money to even start. So the time that you would start feeling pressure to pay school fees and all, they are already 10 years and above. And I'm sure by that time, depending on the contributions you put in, you'll be able to afford that. If you have all these 4 things in there planned, we believe that you should have a good retirement life. Now, this is a basic calculator that we've put together that when I'm done with sharing the slides, I will come back to it and then take members through how much you put in and then how much you are likely to get. If you have an expected benefit of so and so amount, how much do you have to contribute every month to get there? I will come back to this. I'll open in the Excel and then we'll do that computation. But this is a summary of what I'll do with you. And what this one states is that this one, we have the number of years that you can contribute. We have, if you are contributing 40 cedis, and that is just to this side of the slide. If you are contributing 40 cedis, where my cursor is, for the year for the first year, you would have contributed a total of 480 cedis. But your AUM or the total plus interest will be 532. This 40 cedi a month. By second year, you see that you have only contribution for 2 years is 960. Your interest will be around, your total money will be around 1,002. That's an interest of over 300 cedis. And then when you, by third year, you would have contributed 1,440. That's 40 cedis still, though. You've not increased it in any way. Your total will be 2,1. And when you move to by seventh year, you've contributed 3,000, but the total interest or the total money you have is about 9,000. That means the total interest is like 6,000 and something, which is like times 2 of what you have. So that's like 200% of what you have actually put in. That's 7 years. And this, if you put 0 here, that's 400 cedi. You should expect to be making 90,000 over by that time. And it goes on and on based on your ability and your what you have. You can decide to put in whatever you have, and then you get a corresponding returns. The one doing 400 cedi now, in 7 years, is expected to get something around 99,000. The one doing 1,000 cedi will get way more, which I'll show you in the slide that I will show this thing. So quickly, before I end this thing, let me go back with this, and then, okay. Let me try and make this Excel big. Still going. Let me. Okay, I hope you can all see my screen now.
Yes, we can see it. If we can make it full screen, that will help us.
Okay, I'm trying to increase the size.
Yeah, it's not full screen. So. But I guess we can see if that's all you can do. We can see it.
Oh, okay, because I'm trying to.
Oh, we can see it.
I hope it's okay. All right. Okay. So what this tries to do is that assuming the average salary worker with the laboratory scientist is earning 5,000, and you want to put 5% in your personal pension. That's the 5% you see below. 5% monthly contribution is 250. 250. That means that if that person is 35 years now, that means the person has and the retirement age is 60. The person has 25 years to contribute. If I'm using the current interest rate there, which, okay, this one is way above. Let me use, let's say 20%. That person is likely to earn about 2.1 million at retirement. You are doing 250 every month. You are not increasing it in any way consistently for 25 years. You are likely to get 2.12 million. I don't know what excuse we have now, because even the data that some of us even use a day by doing 10 cedi, 10 cedi, 10 cedi a month is 300 cedi. And that 300 cedi, if you were putting it away every month for the next 25 years, you're likely to get 2.12 million. For those who are 40 years, this 2.12 million, you can write it somewhere. For those who are earning, who are 40 years, you see that they only have 20 years to contribute. So the amount has reduced to what? 777,000. Now, I want you to watch the difference. Those who were 35 years, just 5 years difference, 35 years, and they contributed for 25 years, they were able to make 2.12 million at 60 years. Those who are 40, doing the same 250, earn them only 777. That should tell you, say, for the tier 2 and tier 3, or any investment that works with compounding interest, that works is compounded semi-annual, that is every 6 months. That's interest working on interest, principal earning interest, and the interest continue to earn interest. That is how it works. If you come at a later stage, it's expected that you increase your contribution to be able to get more. If I try to change this salary to, let's say, 10,000, just for me to increase the monthly contribution, if I change it to 10,000, that is 500. You find out that for the one who is 40 years, the only way he was able to get twice or more, that is from the 777,000 to 1.5, was if he increases contribution by 500. That what this indicates is that for those of us who are 50 years, for us to be able to earn significant amount during retirement, because we have only 10 years to go, we need to be putting in more money before we can earn significant amount during retirement. But a 1 million or 2 million at retirement is way better than having zero, as most of us will get, and will be shocked and probably die with a shock. Now, apart from this side of the template, we also have this side, which you can input how much you want. So for me, let's say I want 5 million Ghana cedi at retirement. Let me see how many zeros I have, the 5 million. If I want 5 million, what I'm supposed to do, and the age, assuming I'm 40 years, that means I need to put in 1,600 every month for the next 20 years to get 5 million. If I'm 35 years and I want the same 5 million, I just have to pay 600 Ghana cedi every month, and I get 500. I know most of us spend 600 Ghana on a lot of things that will not benefit us in any way, but it makes us happy now. So it is something that we do. But if you can allocate 600 cedi into a personal pension fund at an average rate of 20% without even increasing the rate in any way, you can be rest assured that you can make 5 million in the next 25 years. I'd like to end here. If there are any questions in regards to this, we'll be working along this as we go on. Thank you very much.
Thank you so much, Mr. Nano Baxton. We thank you so much. It has really given more to think about towards our retirement, and we hope to really take it serious so that we can actually plan for retirement early. It shouldn't be a period whereby we feel so down, rather be happy. Of course, definitely to come. We thank you so much for your presentation. It's so insightful. All right, you're welcome. Thank you. So some questions are, let me look at the questions. Someone asking, do I need a corporate entity to contribute towards tier 3, or I can do it myself?
Okay, so thank you. For the tier 3, that's why I mentioned personal pension. You can go as an institution, you can go as an individual. Most of us have the institutional ones, and we also have the individual ones. What it does is that for the institutional ones, again, you can handle it in 2 ways. Where one for one, you can have either is deducted before your tax is paid, or you pay directly from your account to the account of the corporate trust. So that what we do is you can either do it via Momo, direct debit, any way you want to do it. So you have to then reach out to the corporate trustee or reach out to us. We'll send you a form to fill, and then you send in addition with a copy of your national ID. And then we'll send you an account that you pay to. The account that we use is GCD, which I believe most of you are close to. So you can always pay that money to GCD or make a direct debit on your account and it's paid there. So you can do it as an individual or do it as an institution or both. Thank you.
All right, thank you. Okay. Mr. Ernest Bedubuati, kindly unmute and talk.
Hello.
Yeah, please, we can hear you.
Yeah. It's just a little contribution to the delivery by our gentleman. You see, most of us we don't do budgeting at the end of the month. You know, we just go and withdraw our salaries and we spend. If I ask most of our colleagues what we even spent our salaries, our last month's salaries on, some of us may not even remember what we spend the money on. So in order to maximize your pension and be able to live comfortably, this personal pension plan is critical, because if you don't do that, you may end up with what you call a deficit when you go on pension. And we must check our expenditure, because if you don't check your expenditure and put pen and paper to everything you spend on, you may not know even how to save and invest towards your pension. Like this COLA that is coming this very month, people will just spend it, even though now you are living within the money you are getting now without the COLA. But the COLA will come, they will spend it. They will not even think of, let's say, putting that money away and investing it for the future. So colleagues, please, let's really try. No matter how much you are earning, no matter how much your expenditure is, try and put something aside and invest as your personal pension towards your future, because your children, your family may disappoint you. Thank you.
All right, thank you. Thank you.
Thank you very much. Before we move on, I'd like to add a little to what the gentleman just mentioned. There's this app on Google Play Store, which we call the spending tracker. The app looks like a wallet. That app, if you want to track how your spending goes in a month, for some of us, that's what we use. So once you get income, there's a part that you put income and a part you put expenditure. If you do that for 3 months, you'll be able to know where your money goes to. Exactly. So that when you want to, if let's say you spend a lot of money on things that you consider as not so necessary or basic, it will help you to restructure your finance, because none of us make enough. None of us make enough, but we still have to contribute towards our pension. So we need to make it a point that it is something that we need to plan to. Just as we pay school fees and we pay electricity bill and rent, and we send monies to people every month, we should know that this is, and also we pay tithe for the Christians in the house. We should know that we need to also pay ourselves some monies, which we call the personal pension, something that it is also going towards your retirement. Thank you very much.
Thank you very much. There's a question in the chat room. Let's look for it. Somebody wants you to go over the plan for contingency plan for retirement. Contingency plan, that's what he's asking.
The contingency plan for, okay.
Yes.
So the contingency plan is an investment portfolio that you invest in, which is solely supposed to mitigate against any unforeseen circumstance. So just like my brother mentioned, COLA is coming in. Most of you without COLA will have still survived. Even if without that money, you still survive. But yet, people will have it employed because we don't have a plan for it already. And so the contingency plan is supposed to be a plan that you have. You see, budgeting and financial planning is not unique to those who do economics and finance and those things. Each of us do planning on a daily basis. And those who fail to do it are those that are always in debt and they borrow. For it will surprise you that even for people that earn lower than our salaries are managing the way they want to manage. Most of us are living in apartments that are way above our pay grade. we have taken our children to schools that are way above what we can pay. Because it's good to have good education, but you see, everything should be tied within the budget that you run. Some of us, with the fuel increment, have left our cars in the house. Most people are still driving 4x4, and by 2 weeks, the money is in, then they will go back. Some of these monies are supposed to go to your contingency fund. Like I mentioned, even for the newly married couples, of course, once you are married, you give birth. Some people even do naming ceremony, and when they get a contribution, because they are already in debt, the monies go straight to pay debt. But if you have some of these contingency plans, once you get something from a naming ceremony, it's advised that you put that money in an investment portfolio for the kid. Then every month you are putting the money in there. Once the kid is a year, I believe that month-on-month contribution, that kid has a lot of money. If that kid will start school by a 2 or so, by that time you should have enough money in that portfolio to finance that school fees expenditure. But if you don't do that, or most of you rely on provident fund, and for some people, what they tell me is, oh, the provident fund there, every year, I withdraw. Forgetting that it is money that you are putting towards your pension. And once you go for that money and misuse it on Christmas, bonanza, and all those things and enjoy, know that in future, you are on your own. So the contingency plan is supposed to be a fund separate from the tier 3 or the provident fund, which will give you the access to withdraw. But know that it is what you put in that you can withdraw. And so you need to finance it in a way that it will be able to take care of your expenses. What I advise my colleagues and my friends are that even with rent, for those who pay rent, you know how much rent you pay now. Trust me, the next rent you are going to pay, they will increase it. If you know, say my rent is 10,000, divide it over the years that you pay it. Know that every month when I take my money, I need to take this part of that money down as investment for rent. Now, in 2 years, even though you've saved 10,000, because of the interest, you're likely to get around 14,000. Now, this 4,000 that is on it will still be in the portfolio once you take that 10,000 to pay that. Or better still, the increment that will come as a result of the rising cost of living, that increment will be taken care of by the interest that you've put there. But most of us are living our lives based on shock. If you are there and you hear this, hey, you are there. If there's a party, you are there. If there's this, forgetting that planning is important for everything, especially for married people. Planning is important. You can today even be in a house that the landlord will say, okay, I'm increasing the rent or doubling it. Where are you going to get the money from? Most of you will now be looking for provident fund to go and withdraw from. But if you have a contingency plan down there, that is what can save you during that time. Some of you might have done insurance policies and all that. Insurance for education, insurance for funeral, and a host of that. That is good. Insurance policy is supposed to help you if in case of demands and blah, blah, blah. Education policy is supposed to help you get some money if you've done it for a period of time, blah, blah, blah. But you need to pay particular attention to some of those policies that those in the public sector sign on to. If you sign on to an educational policy, which is supposed to, you can recoup after 8 years, know that if you have any unforeseen circumstances, you can't go and withdraw. Because if you withdraw, you will not even get a single interest on the money you've contributed so far. And you'll probably even be charged for penalty for withdrawing before the 8 years. So what I always tell people is that it's good to have insurance, because insurance is supposed to be that in case you die, which we are all praying against, then the insurance will kick in to take care of your children. That is what it's supposed to be. But if you want something that you can rely on to take money from, to finance your as and when expenditures that come in, which will be a drag on your monthly salary, then we advise that you do what we call contingency planning or contingency fund. Thank you.
Thank you. The question from Amos is asking whether the deduction can be effected from controller.
Yes, the deduction can be done from controller. But one thing I've noticed with the controller deductions too is that sometimes when they deduct the money, let's say today, which is 13th August, they tend to remit the money to the trustee next month, which is like 14th of September. And in doing that, what it means is that your trustee or you, the one contributing the money, have lost a month's interest, which nobody will pay you for. Because the trustee will only record your money on the day they receive the money. So what we always advise is, instead of telling controller to do the deduction to the corporate trustee or to us, what we advise is that rather put a direct debit on your bank account. So when the money hits your account, you know, say, okay, 500 CD is for my personal pension. So if you withdraw, if your money is 3,000, withdraw 2,500 and leave 500. Once the day ends or the time that you have given that the money should be taken out, that money automatically is taken from your account. And that is it. For me, that one, once they take it today, probably it will reflect today or early tomorrow, you get it. But as a group, again, controller can do that as a group on your behalf. But know that just like we have delays in how do you call it, your normal tier 2 and all that, it also has a month drag to your corporate trust. So even though it was deducted from your account when they were paying your salary, the time the controller will meet your trustee might be probably after a month. That is the only key. But you can always go there or tell controller to do that deduction on your behalf. Thank you.
Well, thank you. Someone's asking whether SNIT does tier 3.
No. And again, for SNIT, for me, I don't work as SNIT, honestly. I'm with tier 2 and tier 3, but SNIT do not do tier 3. SNIT doesn't do tier 2. SNIT only does tier 1. And by tier 1, we mean the past credits and monthly payments now. That is the two that SNIT handles. So once you've worked before, I think the years before the new Pension Act, they calculate that as past credit and give that one to you as a lump sum, and then they start paying your monthly contribution. So that is how that one works. So I see some people see the tier 2 and they call it SNIT tier 2. Some call it SNIT tier 3. It is not SNIT tier 2 or SNIT tier 3. It is just tier 2 and tier 3. SNIT is for tier 1. Thank you very much.
All right, thank you. Someone's asking whether he can do under tier 3 beside the 3 tiers that we have, and where can he do it?
Again, this I've said over and over. For the tier, yes, when I show the retirement planning graph, I don't want the Excel to go away. That's why I'm holding on to it. The contingency plan has tier 1, tier 2, tier 3, which is provident fund or any other thing. Then we have the contingency plan. The tier 3, you have personal pension and provident fund. So you are at liberty to do or contribute to any of them, which we advise all of us to do it. It doesn't matter the amount, because you know that pension payments are low, very, very low. It's a shock. For those whose incomes are below, it's very low, because the statistics provided by SNIT was that as at August 2021 last year, 53% of pensioners were earning pension, monthly pension below 1,000 cedi. I doubt if any of us can survive on 1,000 cedi now. So imagine if you were retired, you have medical bills to pay, and you are supposed to earn below 1,000. I wonder how you can survive. Thank you.
All right, thank you. Someone's asking whether he can do different territory with different trust managers.
Yes, you are allowed to do tier 3 anywhere you want to do it.
Like,
so
like
tier
different types, maybe with different trustees.
Yes. It's a voluntary scheme. It's something that you are doing. So you can have multiple, unlike insurance. For pension or invest, you can do several. So you can have one at one trustee, another at another trustee, another, based on how their returns are and how you like their services. You can always enroll onto several of them. You have a plan, a master plan on what you want at during retirement. And probably by spreading your risk, you want to share it among corporate trustees. You can do that. You are allowed to do that. You are allowed to do that. Thank you.
Thank you. Someone is asking a personal question. Where you can go and start a personal pension scheme?
You can always get my email or contact from the organizers, and you can also, once you send the email, we'll start.
Okay, so we share with the participants.
Yes, please.
Please, can you make Badela Global the host now? Please, you can do it.
Can you?
Okay. So we can go ahead. We are done for this session. You can go ahead if you have any. I guess you have anything to say again on the calculation.
I don't know if anyone has any question on the calculation.
I think for now, yeah.
Okay. If there are no further questions or anything, and everything is captured, then all I can end with is that pension is inevitable, retirement is inevitable. You either choose to enjoy it or you choose to suffer. There's a saying that if you don't take a decision on your pension, it will be taken for you. So whatever you do, the decision will be taken. So if you fail to contribute towards a personal pension and you have you fail to contribute towards a personal pension, and then you also have you fail to contribute towards a personal pension, and you have this there, you should know that for whatever the issue is, at the time you are going on retirement, you face the challenge that most people are facing now. Now, a lot of people also make the mistake of going to using the thinking said they can use the lump sum money to complete their house or start farming or do so many risk things that they never really have any experience in. What we advise is that please don't. Again, with regards to accommodation, the investment as experts always say that there's something called a first home or a first house and a dream house. Don't start as a young man and be trying to build a 7-bedroom house. Even now, 4-bedroom house is deemed to be too big. What we suggested, at least get a 3-bedroom house. 3-bedroom house, if you have 2 kids, they can either be male or female. The boys will share 1 room, the girls will share 1 room. As you get old, you find out that even the kids, once they are 20 years and above, most of them leave the house. And you are left with this number of rooms there, and it's just you. So what we advise is that instead of trying to build a dream house when you are young, which is straining you and you're suffering, and at retirement you still may not have completed our house, try and always focus on a first house. Try and get something done, get your family in so you stop paying rent, and then get a contingency plan, a fund, in addition to the personal pension, so that at every point in time, you know, say, this is what I can do, and this is what I want can help me to secure my family and everything else. So I advise that it is a very serious thing. Retirees, our pensioners are really struggling. Our children will not be there to take care of us. We should cancel that one. It will not happen. Now, most of us are even living in gated house, and so the extended family too will not be there. So I advise that we should take pension in our own hands, know that this is just us. It is what you put in is what you get. If you start early, you reap more. If you start late, you'll be demanded to put in more. And so I'd like to end here and thank you all for your time and for the opportunity. Thank you and have a good evening.
Thank you so much. Thank you too for the presentation. We are so much grateful to you. Please, last week, we should have had, no, this week's, should have had something on Thursday and Friday, which was rescheduled to next week between Monday and Friday. That is on the leadership session. So we send you a broadcast message on that. From Monday to Friday, we'll have that one with the DDLF. From Monday to Friday. All right, so thank you. Please, if you can make Bridela Glover the host or co-host, you can search for him and make him the co-host or host. Yeah, please, on next week one, too, we're going to send you a new Zoom link for that meeting. There'll be a new Zoom link for next week's meeting between Monday and Friday. So please, we send it through your emails.
Hello, Kenneth.
Hello, Sebastian. I'm able to make him the, yeah.
No, I can't see any Dela Glover there.
His name is Bright Dela Glover. Bright.
Right,
Dela,
right. Okay.
Bright Dela,
Yeah,
Bright.
Right, Uncle?
No, Bright Glover. Dela Glover. Bright Dela Glover.
No, there's no Bright Dela Glover here.
Oh,
in the
okay.
list of participants.
Okay, probably he has also gone away again. Okay, all right. Okay. Then you can make me a host and so that you can also
Okay.
Okay, you are the host now.
all right. So thank you very much. Thank you.
Thank you, Token.